space aircrafts as well as the paraphernalia necessary for that travel.
Danny, wonderful job. Before we let you go, just a final word, please.
I mean, I think the pictures do it all, John. This is quite remarkable. Seeing him come out, he will be tethered. Again, this is a big step for SpaceX, being able to offer this commercially and just a gorgeous view of the Earth.
Danny Berger, thank you. Just phenomenal photos there, Bramo.
I spent a lot of time actually understanding what these spacesuits have to do. They have to pressurize so that your lungs don't boil over from having no pressure whatsoever in space. They need to fully insulate you from radiation. They need to protect you and give you the oxygen to breathe because there is none in space. There are a lot of technical aspects of it, which is why it is a hurdle to cross. At the same time, how do you make it commercial? How do you get there? And this is sort of the first step in that journey.
Well, it's impossible for any normal person to go up there unless you have billions of dollars and go through all this training. But Jonathan, I love the point you brought up about Boeing versus SpaceX. This is a huge feat for Elon Musk, who's up. He's tweeting about it, saying that the Dragon hatch is open and the cabin is now at vacuum zero pressure. And the ability for this individual, a non-astronaut, to go out and have this 15, 20 minutes spacewalk. Pretty incredible, and feels like SpaceX is really ahead of the curve.
We'll continue to monitor some of these pictures and bring you live photos through the next hour or so. Just to tease up the next hour on this program, just to set things up for you. Coming up next, Mohammed Al-Erin of Bloomberg Opinion will catch up with Ed Mills of Raymond James, Ishwar Prasad of Cornell University, and Simon French of Panmure Liberum. Plenty going on this morning, 8:30 Eastern Time, jobless claims and PPI. And in 1 hour and 20 minutes, we get an ECB rate decision widely expected to reduce interest rates by 25 basis points.
The actual decision may be less interesting than the press conferences is often the case, given the fact that Christine Lagarde could be talking about potentially accelerating some of the rate cuts going forward, given how weak some of the growth picture has been, even though they are more focused right now on getting inflation back to 2%.
Let's turn to some of the price action on the S&P 500. We're firmer here by 0.2%, a little bit of a lift after a three-day rally in the equity market. In the bond market, some big moves yesterday post-CPI. Yields ending the day higher by just a basis point, up another 2 basis points this morning to 367.21 on a 10-year maturity. And just to touch in, check base with what's happening with the euro against the US dollar, 110.20. Lisa, firmer by 0.1%.
Yeah, we'll see if it stays that way after the ECB guidance going forward, given some of the pretty dire prognostications from the likes of Morgan Stanley.
Truly historic morning already here in New York City. Good morning to you all. The second hour of Bloomberg Surveillance up next.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
First of all, global trade, which had adverse consequences that we're learning about to this day, still unleashed an enormous amount of gain for humanity. And with the rise of global trade became the rise of information sharing around the world, which rapidly accelerated the trajectory of mankind. I mean, of note, the Chinese, for example, are leaders in solar. They're leaders in EVs. They're leaders in a number of emerging technologies. In a world which is more splintered, we'll see the gains that the Chinese have achieved in these important areas not shared by the Western countries. And conversely, the United States is a clear leader in AI, along with a number of the European countries. And those gains will not be shared with China and the countries in its sphere of influence. So it's a very clear-cut loss for all of humanity when we have the severing of ties between our countries.
On a practical level, is it getting harder to manage the risks you face?
I think that one has to be aware that there are more tail risks that are harder to ultimately manage.
countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The economy is decelerating. There is a real risk the Fed is falling behind the curve here.
The focus of the Fed has shifted from inflation fear to growth slowdown and recession fear.
The Fed really wants to believe that we're going back to that post-financial crisis, pre-COVID period of exceptionally low levels of interest rates.
Ultimately, what the market needs to see is that the Fed's on a cutting path and that they're cutting towards 3 handle.
If there's nothing wrong with the economy fundamentally, if it's basically on the right track, you shouldn't have an active policy either way.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now with equity futures just about positive, coming off the back of a 3-day winning streak on the S&P 500. We are higher by 0.1% on the S&P. On the NASDAQ 100 right now, we look a little something like this. Up 0.1% on the NASDAQ. On the Russell, some outperformance on the small caps, up by 0.6%. The stage set as follows this morning, 8:15 Eastern Time. We get an ECB rate decision, widely expected to reduce interest rates by 25 basis points at 8:30. PPI data and initial jobless claims, then at 8:45. A news conference from the ECB President, Christine Lagarde.
I would argue that watching initial jobless claims will be important, and arguably more important for just this morning's actions may be listening to what ECB President Christine Lagarde has to say about the forward path for interest rates, given the fact that they're facing a much weaker picture and the fact that a lot of people are baking in either more rate cuts from the Federal Reserve or equal, and that I think is going to be a big risk potentially to the euro.
Before we get lost in our problems, a reminder in the last 20 minutes of how small those problems actually are. From space, the first ever commercial space war taking place in the last 10 minutes or so. Some amazing pictures coming in.
You're going to use that for me every single morning. I'm going to start talking about anything. Just remember, from space, you seem really irrelevant. Look, this is actually a really important moment just to understand commercial spacecraft and space exploration, but also because there is this question of the private-public partnership in space at a time where that's an increasing geopolitical risk, as well as just the future of energy and a host of other potential initiatives.
Isaacman, as he's out there in space, says, looks like a perfect world. Back at home, we still have a lot of work to do, but from here, it looks like a perfect world. Definitely a lot of work to do.
We'll keep sharing some of those pictures for you as they come in from that SpaceX capsule. Live from New York, welcome to the program. Let's start with the price action. Equity futures on the S&P firmer here by 0.1%. In the bond market, yields are higher by 2 basis points, 367. In Europe, we keep going back to this question. If we've had a big debate about going 25 or 50 at the Federal Reserve, given the economy we have, given the economy they have, why are we only talking about 25 today?
And what's the potential consequence if they indicate that they are thinking of something more than that later on? Morgan Stanley, you mentioned them earlier. Just a couple days ago, we're talking about the potential for almost parity, a decline of about 7% from here, going down to about 102 versus the dollar, at a time when potentially the ECB has the ability to surprise to the downside in terms of how far they can take their rates.
The euro in and around 110. The lineup this hour looks like this. Coming up, we'll catch up with Mohammed Al-Erin of Queen's College, Cambridge, on his outlook for the Federal Reserve. Ed Mills of Raymond James as Harris and Trump return to the campaign trail, and Simon French of Panmure Liberum as the ECB prepares to reduce interest rates once again. We begin with our top story, the latest CPI print boosting expectations for a 25 basis point cut from the Fed next week. Mohammed Al-Erin of Queen's College, Cambridge, writing on X that he sees a, quote, anchorless paradigm, one that is crying out for the stabilization influence that usually comes from a dominant economic narrative rather than the current ping-pong one, and or forward policy guidance, as opposed to this era of Fed excessive data dependency. Mohammed has a lot to say, and he's with us for the next few hours to say it. Mohammed, good morning to you.
Good morning, John.
Fantastic to catch up with you, sir, particularly your observation yesterday about what was developing in the bond market at the front end of the curve. The swings we saw on the 2-year. Can you share your observations with our audience right now? What was that about?
So we saw a 20 basis points round trip in the 2-year. 20 basis points. That's a lot for that maturity. And we learned two things. One is that we have excessive data point dependence. All that happened yesterday in the inflation report, as people know, is that monthly core came slightly harder than expected. Everything else was aligned, and yet we moved 10 basis points up. And then we discovered a second technical, which is money on the sideline being put to work quickly. And that, I think, is our reality, is that we don't have a dominant economic view, so we get swung all over. But the stabilizer right now is this technical of cash on the sideline. Now, financial conditions are good stabilizers with two very important qualifications. They are volatile, and they have as much perception as reality. So we are going to continue with this volatile world until we restore either a dominant economic paradigm or we restore the power of forward policy guidance.
You could argue that even in the face of all of this volatility, it shows how strong the economic system is, that there wasn't some sort of significant disruption. Isn't that sort of the ultimate stress test, that when the benchmark rate swings around by 20 basis points, you don't see any massive selling? Why is it more pernicious than it might seem on the surface?
So I do think the financial system has been strengthened, and in particular the banks. And we are in a much better place than we were in the past. So you don't get the massive balance sheet effects. You don't get the sort of virtuous cycles, good or bad, that can happen from that. But don't forget that we are the benchmark for the rest of the world. And we cause quite a few spillovers that the rest of the world says, you know what, enough now. We've had enough of this. Please get your act together.
I was surprised at Jackson Hole. To your point, there wasn't more of a discussion, at least not out loud, about what the neutral rate is. Essentially, that sort of paradigm shift that you're looking for, some sort of real discussion of what this Federal Reserve is willing to accept in terms of inflation and a benchmark rate. That said, it sounds like they just don't agree on one. So how can they come up with one if they don't really have that certainty? And frankly, if the market can't agree on one either, is it better just to have one, even if it's wrong?
So, as usual, you're getting me to front-run my Financial Times op-ed tomorrow.
That's what you're here for.
That's so I think, Lisa, you're absolutely right. But it's not just that we don't know what the destination is. We don't know what the journey is. We don't know what risk mitigation mindset actually means operationally. And also, there's disagreement as how quickly will Fed officials go from backward-looking, data dependence, to forward-leaning. So we have this disagreement both within the FOMC and also between the market and what seems to be the consensus, if there is one, on the Fed. So this is, for me, it's a fascinating time, but it is also a very confusing time.
So amongst all this confusion, what do you want to hear from Jay Powell next week?
So what I'd like to hear and what I expect to hear is that he's going to cut by 25 basis points. Beyond that, it's more what I'd like to hear than what I expect to hear. I'd like to get a sense of where he thinks the neutral rate is. I'd like to get a sense of where he sees the balance of risks. The market right now has modeled the Fed as a single mandate Fed, maximum employment. Fed officials tell us, no, we're dual mandate Fed. Let's not forget the inflation component. I'd like to know where he is on this.
Do you want to hear more dissent within the Fed?
Yeah, I would like to. I mean, I admire the Bank of England. The last decision was 5-4. You had a situation where it was 6-1. I think that's important because that conveys the uncertainty. Yes, they should have more dissent. I think they view dissent as weakness. Most of us view dissent as having a really important information content that has to be priced into markets.
I remember a series of votes at the Bank of England, maybe a decade or so ago, I'm sure you remember this too, when the committee was outvoting King. and Governor King was leading the central bank. I think at the time he wanted to increase QE, and you had people on the MPC voting against him. Not only that, there were more people voting against him than voting with him. That's a scenario we don't see at the Federal Reserve. You had a warning coming into the September meeting, and I remember it at the start of summer. You wanted them to reduce interest rates in July, but you acknowledged that the difference between going into September versus July wasn't that great. But you had one fear. If we got one hot CPI print, they might get distracted. Was that what we got yesterday? How distracted might they be?
I don't think that much, because it was just one element in a broadly consistent data release that certainly was very close to consensus forecast. But if we had missed on headline, if we had missed on core, if the base effects weren't as favorable as they are right now, you would have seen a total mess in the marketplace. So yeah, that was my concern, is that as much as they don't want to admit it, they are not just data dependent, they're single point data dependent. And that's pretty scary for policy setting.
That's certainly how the market sees it, because it guided the conversation away from 50 and back towards 25. How do you think they'll look to frame this rate cut when they deliver it a week yesterday? Will they call it a mid-cycle adjustment? Will they say it's the beginning of a journey back to neutral, whatever neutral is? How do you think they're going to frame this decision?
I suspect it will be what's called a dovish 25 basis points, which means this is the first of many. And we may be inclined to go even more if the labor market weakens. There was this phrase in the Jackson Hole speech that was really important. We don't want to see the labor market get any weaker. That is a very strong statement from the Fed chair. Whether everybody else is there, we don't know.
Let's say they do what you want, and they come out, they say, this is what neutral is, this is our journey, this is our mandate, this is what we're going to do. How much have they lost control of the plot anyway? Just simply because there are other factors at play. You think about, for example, fiscal coming out and potentially disrupting things. Think about international investment with an auction that's necessarily negative, that kind of forces their hand. How much do they have ability to set the narrative with such a prescriptive tone right now?
So they certainly should be incorporating fiscal. They must be doing this. They certainly should be incorporating QT. I mean, we haven't talked about QT. QT is ongoing on that. They certainly should be doing that. And that should be reflected in what they say. I hope they're doing this internally. I just think they got so burnt in 2021 because they did take a forward-leaning view and they were completely wrong, that they don't want to make another mistake.
What if they say this is a victimless crime? We're not seeing a problem from this, that essentially they're getting it right, and the markets are generally, you hear traders actually say, Ashley Powell's doing a pretty good job. So why should they change it? What would your argument be?
Well, first we'll go back to the amount of volatility we've had in fixed income. It has been unusual, Lisa. Okay.
I know, I watch it every day. We were talking yesterday, it was crazy.
Okay, and that has adverse external effects. It undermines also the credibility of the US as the benchmark for many others. And we are in a world in which countries are building little pipes around the US. We don't want to enable that process further. That's the first issue. The second issue is we have a major reconciliation in our future. We have the treasury part of the fixed income market that is signaling quite a high probability of recession. We have the credit part of the fixed income market that is signaling a very high probability of a soft landing. Now, if liquidity doesn't reconcile these two things, there's going to be even more volatility in this marketplace. And at some point, volatility spills back to the real economy. And the only thing keeping this real economy going right now is the labor market.
I'm sitting here laughing because we need to clarify what you said. Market participants that think Powell are doing a great job, they're the bullish ones.
Yes,
Let's be very clear about that. Equities are still near all-time highs.
Yeah.
If we weren't there, I think they'd have something different to say about where we were.
Maybe they're data point dependent as well,
Yeah,
in terms
their
of their
data point
judgment.
is the S&P 500.
Correct.
You mentioned where the bond market is and where markets are and how they're priced. I want to pick up on the amount of demand we've seen for some issuance. We had a gilt issue last week, record order book. Had an Italian issue this week, record order book. We've seen a similar dynamic in US high-grade corporate debt in America, particularly last week. 2 very busy days, lots of demand, credit spread stayed very, very tight. Can you reconcile what each part of the fixed income market is telling us right now and whether you can make sense of it?
And we had yesterday a treasury auction with massive indirect demand. I can only reconcile it by the ton of cash that's on the sideline and the fear that if you don't get into and lock interest rates now, you will lose interest income in the future. So every time we have a backup in rates, people rush back in. I mean, yesterday's dynamic was fascinating for me. The speed of the round trip was significant.
We've seen it a few times in the last week. Mohammed, we're lucky to have you. You're going to stay with us through the ECB rate decision and right up until that ECB news conference a little bit later on this morning. Equities right now are firmer by a little more than 0.1%. Let's take the opportunity to get you an update on stories elsewhere. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. The family behind luxury brand Chanel and the billionaire heiress of L'Oreal have bought a stake in the fashion label The Row, founded by the Olsen twins. People familiar say the Wertheimer brothers have bought a minority stake in the fashion brand. Other investors are also likely to join the deal, which values The Row at about $1 billion. The Row was started in 2006 by sisters Mary-Kate and Ashley Olsen, who had shot to fame as children actresses in the late 80s in the sitcom Full House. General Mills agreeing to sell its North American yogurt business for $2.1 billion. The New York firm will sell U.S. and Canadian operations, including the brand Yoplait, to French dairy companies Groupe Lactalis and Sodial. The proposed transactions are expected to close in 2025, subject to regulatory approvals. General Mills will provide new details in its next earnings report next week. More turbulence could be ahead for Boeing. The plane maker's 33,000 union members are voting today on whether or not to strike when their current contract expires at midnight. The new CEO, Kelly Ortberg, urged members not to strike, warning that a work stoppage could negatively impact recent efforts to turn around the company. And that's your brief, John.
Hey, Danny, thank you. More from Danny in 13 minutes' time. Up next on the program, returning to the campaign trail.
People start leaving his rallies early out of exhaustion and boredom.
People don't leave my rallies. We have the biggest rallies, the most incredible rallies in the history of politics.
Talking about taking the bait. That conversation up next from New York this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Equities right now firmer by 0.1% on the S&P 500. In the bond market, yields a little bit higher, up a basis point or two, 367. In 1 hour from now, we'll be very focused on the euro dollar right now, 110.18, just about unchanged. An ECB decision just around the corner. Under surveillance this morning, returning to the campaign trail.
I'm going to actually do something really unusual, and I'm going to invite you to attend one of Donald Trump's rallies, because it's a really interesting thing to watch. People start leaving his rallies early out of exhaustion and boredom.
She said people start leaving. People don't go to her rallies. People don't leave my rallies. We have the biggest rallies, the most incredible rallies in the history of politics. That's because people want to take their country back.
I know you want more of this, so here's the latest. Kamala Harris and Donald Trump, each set to hold rallies today in swing states, with Trump in Arizona and Harris in North Carolina. Ed Mills of Raymond James writing, we expect a near-term bounce towards Harris following the first debate, but the longer-term impact remains unclear. The continued lack of specific policy details may not meet undecided voters' information threshold, and we continue to expect a very close election. Ed joins us now for more. Ed, wonderful to have you back. Welcome back to the program. We've heard from a lot of people in the past 24 hours who have suggested that a Harris presidency would be good for bonds and perhaps bad for stocks. Is that what your conversations with clients sound like, or does it sound a little bit different?
John, I think at Raymond James, our conversations are much more nuanced than that. We're looking at each specific policy, looking at every sector. What we've done is on every sector of the S&P 500, put out a report and said, here are our top picks in each of these scenarios. Because as we look at stocks, we certainly could see a rally because of the extension of the tax cuts, but a pullback because of an extension of possible tariffs if Trump were to win. With a Harris victory, there would be concern. Are those tax cuts going to end? But not having those trade fights are a really important put and take that a lot of our clients are asking for. And probably one of the biggest parts of the debates are, because the Supreme Court fundamentally altered the way in which we're going to do regulation with a series of cases this year, clients really want to know what can be done with executive action, what requires regulation, and what requires Congress. Those nuanced conversations are much more than one good, other bad.
So, Ed, let's sit on that for a moment. What can be done via the executive branch solely, besides tariffs?
Yeah, Anne-Marie, so it's tariffs, anything national security related. When we look at the tech export controls, and we got a big headline yesterday that the United States government is going to allow Saudi Arabia to receive certain semiconductors, those are authorities that rest within the executive branch. That does not require Congress, that does not require any kind of long-term regulation. When we look at the Trump policies, leading off what he wants to do are some of those things that don't need Congress, that don't need regulation, and those are the threats next year. The other conversation is we're looking at a Fed cut here. When we're taking that all into consideration, does the uncertainty of one outcome versus another change the path of the Federal Reserve? Another huge kind of conversation with clients at Raymond James.
Ed, I'm intrigued by your notion of, quote, information threshold. What does that information threshold look like?
Well, it's a really good point, because I think that if we would have gone back to 2016 and you had a Hillary Clinton campaign that had a 10-point plan for almost every outcome and was actually kind of won the debates but lost the election, are we looking for that standard? Probably not. But what we do have is a nominee that is relatively new kind of to the American people, despite the fact that she has been vice president. When we look at the polls, it says that there's about a third of undecided voters who are saying, we want to know more about who Kamala Harris is as a candidate, how she would be different than Biden. Because remember, the Biden-Harris administration is pretty unpopular. Right track, wrong track in this country is underwhelmingly, voters say we're on the wrong track. So they probably, for an information threshold, what is she the same, where she's different, what are the tweaks, what is her vision? And I think voters are asking, is this a candidate that I can trust? Is this a candidate that I want to live the next 4 years with as the leader of our country?
As you noted, the conversations you're having with corporate clients are pretty nuanced right now. What are corporate clients actually doing with some of the information that you're giving them? How are they adjusting to the potentially binary outcomes of an election where people have a lot of question marks still?
Yeah, I think that we're trying to make sure that they know that this is an extremely close election. We had the market vote yesterday that they thought this had swung towards Harris. You saw solar stocks up. You saw massive moves in some healthcare names. So I think what they're doing is, if there is a sense that it's moving in one direction or another, they want to thematically be there. And they're also trying to get a sense as to, do they put the trade on now, even though it's imperfect information, Or once we get the outcome of this election on November 5th, is that going to be a sell the news event? So it's traditional kind of conversations that you have. I kind of meet with a lot of board of directors with banks. They're trying to get a sense on whether or not right now is the right time to think about M&A opportunities, because that's been completely stagnant. So there are a lot of corporate decisions that are being made now or getting prepared to be ready to kind of hit that starting gun as soon as they have that outcome known.
Ed, I'd love to know the probability of who's willing to put the trades on now.
Well, it's your traditional hedge funds. It is kind of the faster money in the kind of conversation. But I do think, to that conversation about what can be done with regulation, what can be done with executive order, the kind of final conversation I think is really interesting is what are some things that happen regardless of the outcome of this election? So regardless of the outcome of the election, we're going to see a major change in which regulation is put on because of the Supreme Court. We think that as we look forward, you are highly probable to get changes to permitting for energy projects. So people are still very optimistic about CapEx spend. Regardless of the outcome of the election, we've had massive fiscal stimulus that has been approved by Congress. 80+% of that money that's been directly approved by Congress has not yet been spent. So that digestion that has to occur regardless of the outcome of the election are good thematic trades that we've been suggesting here at Raymond James.
Ed, thank you, sir. Ed Mills there of Raymond James on the latest. I think we've got to pick up that story on the lack of M&A. It would be borderline idiotic to try and take over someone else in your industry right now and make yourself a target for the campaign for the next 2 months. Who's going to want to do that? Nobody should want to do that right now.
1-800-Nippon Steel. I mean, this is essentially what you don't want, right? However, there is a question of whether to lay the groundwork to get some kind of merger done now if you do believe that Lina Khan is no longer going to be at the FTC, or if the next administration is going to be a little bit more amenable to certain tie-ups.
What we do see right now is people laying the groundwork to try to influence both campaigns to not have, at least some of the big donors, to not have Lina Khan stay on, or someone like her potentially in a Trump administration.
Harris is struggling to answer that question. I wish it had come up on the campaign, in the debate in the last few days. I just wish it had come up a little bit more. Hardly touched the subject.
What her vision is in terms of what the competitive landscape should look like and how to achieve that, where M&A falls into that.
Or to borrow a line, got concepts of a plan. It's going to be the new line, right? Concepts of a plan.
I think that was, we haven't talked about that enough.
Concepts of a plan. I've got concepts of a plan for this program. Up next, we might catch up with Ishwar Prasad of Cornell University, joining us to discuss the potential impact of Trump's tariff plans. From New York, this is Bloomberg.
the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
3 days of gains on the S&P 500, looking to make that day 4. In 60 minutes from now, we'll have some data for you, PPI and initial jobless claims. Equities at the moment, just a little bit of a lift. You see it on the Russell, the small caps advancing 0.5%. In the bond market, 2-year all over the place. Yesterday, Mohammed's got plenty of reasons as to why. The 2-year yield higher by 2 basis points this morning, 3.66. The 10-year up a single basis point, 3.66.
I'm still thinking about what Mohammed was saying about how the more volatility there is in the U.S. rates market, the more other people create off-ramps for the U.S. Market to try to use that as a benchmark. That's an idea I want to explore a little bit more.
I was about to quote Mohammed, then realised he's still sitting next to us, so to speak for himself. Mohammed, the beginning of the end of U.S. exceptionalism or a risk around U.S. exceptionalism? Which one?
I think a risk around U.S. exceptionalism.
Okay. And that's manifesting in the market in what way? In gold as well, and not just in bonds?
I mean, it's manifesting in the fact that the buffers that we've had for the economy, really important buffers, are mostly gone. And now we are income dependent, not just income and balance sheet dependent. We are income dependent, and the most important element of income is labor. I cannot stress how important the labor market is right now.
Well, let's talk about the labor market and what isn't happening over in Europe. I understand it's a single mandate central bank. We're going to talk about Eurodollar, the ECB, in the next 45 minutes, a whole lot more. Do you find it odd that we're not talking about bigger rate cuts at the ECB when we're having that conversation about the Federal Reserve?
No, I don't. Why? First of all, as you said, it's a single mandate. Second, the behavioral bias is clearly on the inflation side. That is how the DNA is. That's how they react. And then thirdly, it depends which part of the Eurozone you look at for your growth outlook. So if you look at Germany, yes, you would worry. If you look at the periphery, you wouldn't worry. And they are trying to make a policy for an area that's very dispersed right now in terms of economic outcomes.
Yeah, but this is the reason why it's so hard to understand exactly what the outlook for the Eurodollar is. Given the fact that you've got the likes of Morgan Stanley talking about parity, given that the economic outlook is so negative, does it actually do more to attract money to the U.S. to cut rates more aggressively at a time of uncertain inflation outlook? Or does it push people away further because there isn't that clarity that you were talking about the journey and the destination by the Fed?
So we solve in a relative world, not in an absolute world. And because we solve in a relative world, the U.S. will attract capital away from Europe. If we were solving in an absolute world, it would be a different discussion. But that's not what we solve for right now. Capital will go from Europe to the U.S.
The ECB decision, 8:15 Eastern Time. The euro right now, 110.17. Under surveillance this morning, Nippon Steel mounting a last-ditch effort to drum up support for its $14.1 billion takeover of U.S. Steel, sending an executive to Washington for an 11th-hour meeting. The deal still opposed by President Biden, Kamala Harris, and Donald Trump, all saying the company should remain American-owned. Can they change that story?
Well, potentially, they could change that story. What I'm looking at is when the CFIUS review is over. This is under really a cloud of secrecy, but once that's over, it goes to Biden's desk. Maybe if they think that this deal should actually go through, and I watch how Josh Shapiro acts on this publicly. He hasn't said whether he backs or opposes, but just that he's talked about how he wants a solution to protect Pennsylvania jobs. When you talk to the union, depends whether you think this deal actually protects jobs or not. Maybe they just need to wait till after the election so this doesn't become political as much.
You just have to wonder what the conversations are like. Can you just tell us, like, after the election, are you guys going to be okay with it?
Exactly.
I mean, that's what I think these conversations are. They're not going to convince them to change their public view.
I kind of agree with you. They're sort of laying the groundwork for what happens
100%.
afterwards. Let's turn to this story. JP Morgan and Bank of America setting new measures to ease the workloads for its junior bankers. JP Morgan limiting the work week to 80 hours. Bank of America pledging to monitor individual workloads much more closely. The move's coming amid industry-wide debates over whether workloads are too often unhealthy. How this works out in practice is up for debate.
Unhealthy means exceeding 100 hours a week. I was calculating what that means. That means 14 hours a day, all days of the week, 7 days a week, 14 hours a day. You're talking about things exceeding that. Is artificial intelligence going to take over some of this work? I'm serious. Like, wasn't this supposed to go away with the advent of computers that were brilliant?
When there's live deals, these days can be even longer, by the way. That's like the ceiling outside of live deals. When there's live deals, those days will be longer.
Yeah. I mean, Mohammed, do you think that this is just, the days are over? That we're going to actually see this? And that basically this is sort of the last gaps of bragging rights for people who can work this long?
I do think you get peculiar work practices simply because you've got to be seen. I'll never forget, I was flying back with a colleague and we landed at about 4:30 in the afternoon. I remember in California, the day starts really early.
What time did you get out of bed for PIMCO?
At 2:45 every morning.
Every single morning? How long was the day?
Well, from about, I would get to work at about 4:15 till about 6. So that's how long the day was. But I want to tell you, we land 4 o'clock in the afternoon. I ask this person, are you going home? They say no, I'm going to work. I say, but work is in the opposite direction of home. And the answer is yes, but I need to be seen at work.
It's a very American thing, that is. Yeah. Not European at all. Have you noticed that? The FaceTime thing, very, very American.
What's interesting to me is that hasn't changed even post-pandemic.
I think it's changed a bit.
Yeah.
Generationally, it's changing.
Well, people don't want to.
Also, the work from home is changing that.
Don't want to work, is that what you just said?
Well, they don't want to be in the office if they don't have to be, just so that they can be seen.
Good save.
Thanks.
Thank goodness you don't work in a Chinese bank. You seen the latest from over there?
I'd be arrested.
No one's going to want to talk about this, but we should. At least 3 top investment bankers from different securities firms have been detained by Chinese authorities since August. One of them, who used to oversee deal-making at Haitong Securities, fled the country, was arrested overseas about 2 weeks ago before being repatriated back to China in an incident that's widely publicized on state media at the moment. Haitong and other state-backed brokerages recently asked many of their investment bankers to hand in their passports and seek permission for all business and personal travel plans, according to people familiar with the matter. Never mind the work week. Imagine working under those conditions.
They have a capped salary. They have capped compensation. If they travel outside the country, they need permission, and they need to travel with somebody else. A real question here about what Chinese authorities are trying to do. Is this just to prevent graft, as they're saying, and to investigate practices where the state-owned banks have a real clutch over which companies really can do IPOs and access the capital markets? Or is this something else?
This is the latest on the banking industry. Let's get you some better news. New York City renters seeing more relief in August, with rents declining in what's typically the priciest month of the year. The median for new leases down 3.5% from last year, coming in at just over $4,200. That marks the 3rd year-over-year drop in 4 months, signaling a cooling off for the market after a year of record highs in 2023. So if you're about to negotiate with your landlord, present this data to them and tell them that prices are moving in the other direction.
Is that what happened in the Farrow household?
That is what will happen at some point in the next few months.
Can I just say, prices are still 21% higher than in 2019, so let's not whip out the champagne.
Don't encourage the landlords.
But I will just say that there is more turnover. There's more churn. I imagine the moving companies are doing just great. And there is a sense that there is an ability to, and I wonder how much this is connected to mortgage rates coming down a bit.
This is my message to everyone, to the people.
To everyone.
Wage growth is still good. Make sure you ask your employer for a pay rise. And the rents are coming down, so make sure you tell your landlord that rents need to come down too. We will make that push together, Lisa.
Can I just say,
things will be a better place.
We talk about Apple, and you always tell me this is deeply personal. We talk about rents, it always gets deeply personal. So I support that. I know, it's great.
It's deeply personal.
All right.
For everyone watching. Turning to politics, Donald Trump's proposed tariffs drawing scrutiny for the potential impact on inflation and the US dollar. Ishwar Prasad of Cornell University writing the proposals could, quote, encourage countries to reduce their dependence on the dollar for trade payments. The irony is that using tariffs to punish countries that use unfair trade practices or are trying to reduce their dependence on the dollar is likely to end up hurting the US economy and consumers. The professor joins us now for more. Professor, it's good to see you.
Nice to be here,
First
Jonathan.
question, is there a better way outside of tariffs? Is there a better way?
Depends on what you want to accomplish. If the idea is to protect American jobs, one approach might be to improve U.S. competitiveness and productivity, because that's what's really it's all about. What China has been very effective at doing, despite all the inefficiencies in the economy, is generate economies of scale, particularly in the new technology industries, that are making them very competitive worldwide. So the U.S. needs to think about how it can improve productivity. Now, if you want to control inflation, certainly tariffs are not the way to go, because the notion that tariffs are going to ultimately end up being paid by the Chinese government is completely wrong. Certainly, there are some products where there could be substitutes, where they are not produced by China, they are produced by other countries, and you can substitute away from Chinese imports. But if you think about a broader policy of adopting tariffs to punish countries for anything that they do that the administration does not like, in terms of trade practices, in terms of the use of the dollar and so on, that is really going to have a very negative effect, I think, in terms of what happens with the dollar, what happens with domestic inflation, and I don't think those consequences are going to be positive.
That's why let's stay on this point, and let's zoom out a little bit and go back to your notion that countries are looking to reduce their dependence on the U.S. I have this image that the U.S. is at the core of the system. It cannot be replaced at the core of the system, so other countries are building little pipes around the system. So it still looks like a dollar-denominated system, but the influence is going down over time. If that is the case, if that is a correct characterization, and please fix it if it's not, at what point does this fragmentation change the way the system works?
It's going to have an effect, but it's your right moment. It's going to be difficult to shift away given the dominance of the dollar in practically every dimension as a medium of exchange, as a unit of account, and as a reserve currency. And the changes are going to be at the margin at most, because these forces feed upon each other. Now, much of the world would like to get away from the dollar, but what we are seeing is a curious phenomenon where the dollar remains very dominant in all of these respects, and in some respects, including payments, it's become slightly more dominant, while there is a great deal of fragmentation in the second tier. So even the euro, which in my view has become a second-tier currency, is sort of duking it out with the Japanese yen, the pound sterling, and the renminbi. On the payment side, there are going to be changes. You know, emerging markets have better payment systems of their own. They have better developed financial markets, so they can more directly trade in their own currencies rather than using the dollar or the euro as a vehicle currency. But here again, what we are seeing is that the share of the other payment currencies like the euro and the yen has come down much more than that of the dollar, and the dollar still remains very important. But there will be changes, and that's going to reduce the efficacy of things like sanctions. So I think we will end up in a system where the dollar is still the most dominant, perhaps a little less dominant than it is right now, and there is a lot more fragmentation, which means there is no serious rival to the dollar.
So do you reject the idea that there will be some sort of incredibly dramatic moment where the U.S. no longer has the privilege of acting recklessly in terms of its borrowing, where suddenly you have this sense that people are really spooked by the volatility in benchmark rates? Are you saying that that will never come to pass just simply because everybody else looks pretty bad too?
In a world that is full of logic, you're correct that we should be seeing a move away from the dollar, given all that the U.S. has done to shoot itself in the foot, the erosion of the institutional framework, Trump threatening that he's going to impose 100% tariffs on countries that try to reduce their dependence on the dollar, the sanctions imposed on many countries that are seen as geopolitical rivals of the U.S., including making it hard for them to use their reserves. They should all be creating a move away from the dollar. But in a world of turmoil, some of it created by the U.S. itself, people look for safety. And then you look for a market that is very broad, that is very liquid, that is very easy to trade in and out of. There really isn't very much out there. And the U.S. very benevolently has been increasing the amount of public debt and therefore increasing the depth and liquidity of that market. So this is a circumstance that is going to be pretty difficult to shift, even though the world dearly wants it.
So if Trump wins, how do you square that? Higher tariffs, but he wants a weaker dollar. Can he have both? No.
Now, that again is an irony, because many of the objectives that Trump has in mind, he wants to accomplish through tariffs, and they're going to have essentially the opposite effect. Because if you impose tariffs across the board, that is certainly going to reduce the amount of cross-border trade, which could almost certainly imply reducing imports, and that is going to mean that the dollar is going to rise because the trade deficit will be somewhat smaller, the financing needs will be somewhat smaller. So you could actually have an appreciation of the dollar. And again, when he talks about, what he's going to do with the dollar, you would think that this should cause people to flee away from dollar assets. But the question again becomes, as Mohammed correctly pointed out, if it's a relative world, you need to find a place to flee to. And there isn't an obvious place to flee to at this stage.
As you know, Professor, there are plenty of reasons to use tariffs to protect domestic industry, to basically say to a country, we're not seeing reciprocity here. This is why we're doing this to you, because you do this to us. There are loads of reasons for tariffs. One is to influence behavior. And when we hear Donald Trump at the campaign trail, he often talks about influencing the behavior of the Chinese. And now he's talking about doing it to everyone. If you don't do this, we'll do that to you. It's not just about national security like it is under this administration. How influential can you be with tariffs? If you want to influence behavior, is it better to use, say, sanctions? When you look at the two options, the two tools, what's more efficient?
Now, again, it depends on the objective. Sanctions have much broader efficacy in terms of making it difficult for countries that have dependence on the dollar, and that's practically every other country, to use that effectively. So in terms of disruption of trade, it's going to help a lot more to use sanctions. Now, tariffs do have the effect of signaling to other countries that American trade policy is going to be very different. Does it really help American industry? What is interesting, of course, is that the tariffs that Trump put in place against China were carried through by the Biden administration, but I think the Biden administration was much more effective in its use of policies against China because it figured out what the real choke point was. China is trying to move into industries that are precisely the industries the US is counting on for a manufacturing revival. The new technology industries, green energy, electric vehicles, and so on. So it is by clamping down on the easy access to chips and technology that you can be much more effective. And that's where I think the Biden administration was more effective than the Trump administration in terms of trying to accomplish the same objective.
I know a book is in the works, so let's continue this conversation. It's wonderful to see you, sir. Thank you. Professor Ishwar Prasad there of Cornell University, with a line I'm going to use forever now. In a world full of logic, you are correct. Isn't that your favorite line now? It's mine.
Yeah, but, and then there's the but. We are not in a world full of logic. This does not make sense given the fact that we are in a relative world where it doesn't work that way.
In a world full of turmoil. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Just moments ago, SpaceX completed the world's first private spacewalk. It's a process which took about an hour and a half in total. During the outing, billionaire Jared Isaacman and SpaceX engineer Sarah Gillis exited the craft one by one. Once outside, they performed a series of mobility tests in their newly designed spacesuits. The primary goal of this mission was to test SpaceX's new suits. The Polaris Dawn crew confirmed that they are now back in the craft, which you can see. The hatch is now closed and the cabin repressurized. Now they are just doing their final checks for leaks. A government shutdown could be looming. Speaker Mike Johnson pulled a short-term government funding bill from the House just hours before the vote would have taken place. Multiple GOP members said that they would vote against the measure, which included a controversial bill to bar non-citizens from voting in U.S. elections. The government will shut down on October 1st at 12:01 a.m. unless Republicans and Democrats are able to strike a deal. The NFL continues to dominate television, posting record Week 1 viewership this past weekend. An average of 21 million viewers tuned in across all platforms. That's up 12% from last season. These numbers come as millions of TV viewers were unable to watch Monday Night Football, with DirecTV and Disney still in a carriage dispute. Week 2 starts tonight with a Thursday night matchup between the Bills and the Dolphins from Miami. And that's your brief, John.
Danny, thank you. More from Danny in 30 minutes' time. Just got a note from Andrew Honhorst of Citi, who I think published this just for the gentleman to the left of me, Mohammed, called it data over dependence, and said an upside surprise to claims this morning or downside to retail sales next week could still push the Fed back towards a 50 basis point cut. We'll get Mohammed's thoughts on the other side. From New York City, up next on the program, rate cuts just around the corner.
The Fed must be aware that if they go aggressive here, they're in danger of undermining consumer confidence. And honestly, the economy is doing exactly what they wanted to do.
Live from New York, you're watching Bloomberg TV.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build. So it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Equities right now firmer by 0.2%. ECB decision about 40 minutes away, 25 minutes away. This is what we look like. We've got a euro at 110.17. Under surveillance this morning, rate cuts just around the corner.
It's really not a bad economy. It's a good economy, and I don't think it calls for any drastic Fed action. I'd be very happy to see 25 basis points next week. The Fed must be aware that if they go aggressive here, they're in danger of undermining consumer confidence. And honestly, the economy is doing exactly what they wanted to do.
The Federal Reserve goes next week. The ECB goes in about 20 minutes' time. The ECB kicking off a string of central bank decisions at 8:15 Eastern, with the Fed next in line on Wednesday. All economists surveyed by Bloomberg expecting a 25 basis point cut from the ECB. Simon French of Panmure Liberum saying investors assume that some of the structural rigidities of the Eurozone are reflected in slow policy inflections from the ECB. Is the Governing Council going to do anything deliberate to alter the forward curve in September? We suspect not. Simon joins us for more. Simon, welcome back to the programme. A question we've asked all morning. Given the growth backdrop across Europe, particularly in Germany, why are they going 25 today and not 50?
It's an excellent question. If the Federal Reserve have the biggest job, if the Bank of England has the hardest job, I'd say the ECB has got the most interesting job, or perhaps the most complex job, because if you look at the cyclical indicators, particularly out of the Eurozone's biggest economies, Germany and France, you would move on from the debate on what is restrictive and what not is restrictive, which is probably the debate we've had for the last couple of quarters, and say, actually, you probably need to go, and relatively quickly, below restrictiveness into accommodating monetary policy and try and front-run the Fed, who markets believe, and markets may be wrong, but they believe that the Fed is just far more nimble in responding to those cyclical signs of a slowdown.
Given what you just said about the complexity, if you were Madame Lagarde today, what would you signal about the future, and how would that compare to what the market expects about the future?
Well, I think if her narrative for the last 2 years has been the primacy of inflation fears to the upside, I think she has the vast majority, if not all, of the Governing Council on the idea that that balance of risks has shifted back towards structurally low growth. And I would say that if she gets one message across, she would amplify the importance of not going back to a low growth, a fearful sort of ZERP equilibrium where we get a very poor allocation of capital. And you know, her predecessor, his comments earlier in the week, Mario Draghi's comments, will be ringing in her ears around the structural rigidities, the lack of competitive zeal in the Eurozone. And she does not want the Governing Council to be accused of reinforcing that dynamic.
Just to take a cue from the person to my right, what does that mean in terms of the pace of the journey and the destination there for where the ECB rate actually is, given the fact that to not return to zero interest rates or even negative interest rates means that maybe they have to do a little bit more up front?
Yeah, look, I didn't dodge the question, or at least I hope I didn't dodge the question. I would go faster than I expect the ECB to do, and you very kindly put my quote from my notes on as an intro. I don't expect the ECB to try and push down the forward curve. I don't expect them to do anything other than markets expect 25 basis points. But, are we starting to talk about some of the rigidities that we often talk about the Eurozone economy manifesting itself in European Governing Council monetary policy? Yes, I think we are. And therefore, you're starting to talk, aren't you, about a policy mistake of not going quickly enough, given what the data is telling you, which is effectively the softest inflation picture amongst developed markets.
If someone were to ask Christine Lagarde, how do you look at the euro in this sphere? She would say, we don't target the euro. We're not trying to influence the euro. We're just looking at inflation and the dynamism of the region. And everyone says, but how much is that a check on how quickly they can go? What's your view on that? Is that something that pressures them to not move overly aggressively in terms of in comparison with the Federal Reserve, just to protect and make sure it doesn't depreciate too much?
So I think the ECB have been in this cycle for a while, including under a predecessor, Mario Draghi, of saying, look, monetary policy isn't here to solve all the problems of the Eurozone. But the reality is, actually, what we are is seeing sub-trend growth indicators on GDP, on PMIs, business confidence, consumer confidence. That suggests that we are demand deficient across the Eurozone, and that requires a cyclical response. So yes, while she may say, and I understand the intellectual framework that she's operating on, which is monetary policy has to be part of a broader return of competitiveness or re-establishment of competitiveness across the Eurozone, but equally, she's facing cyclical underperformance. That requires quite an aggressive monetary policy response at this stage.
Simon, just want to squeeze a UK question in. Why is the government taking money off pensioners to what they say is to save the market? What's going on in the UK?
Well, they've learned the wrong lesson from the mini-budget of September 2022. They think the gilt market needs to hear about austere behaviour, filling black holes inherited or not inherited from the government. I think that's the wrong lesson from 2 years ago. The right lesson is actually about growth. What was poorly delivered at that point 2 years ago was a growth agenda. The market needs to hear a growth agenda from the Chancellor on the 30th of October. Taking money off pensioners to fill a black hole is not a growth agenda. It's trying to address a bond market fear that I don't think is real. I think it's somewhat imagined.
And fund a big public sector pay rise as well, Simon, which they don't talk about too much anymore. Simon French, thank you, sir, of Panmure Liberum. Big austerity budget may be coming from this government. Who knows? It's going to be painful, apparently.
Yeah, it seems like you have a lot of conviction as to Simon. And it's
got some strong questions, no real thoughts.
Yeah, no thoughts.
Strong questions.
ECB
decision round the corner from New York. This is Bloomberg.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Our principles, our policies in support of the Palestinian people will never change. Our policy in having a two-state solution will never change, and nothing will compromise it. And as long as we are, having the capability to be helpful, we will do it. We did that between Afghanistan, between Taliban and the US. We did that between different parties in Lebanon and Sudan and others. And that's basically the core of our foreign policy. It's been built based on mediation, on trying to help in resolving conflicts between the party. There are countries or people might not like it, but we don't ask everyone to like it, just to understand it.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
In equity land, we're mostly pricing in a soft landing circumstance right now.
It's really not a bad economy. It's a good economy, and I don't think it calls for any drastic Fed action.
I don't really care what they do next week. What I care about is how the markets react.
Right now, investors are on edge, and so far it's been a good year, so you could see some people continue to take profits.
For the equity market, volatility is going to dominate because from here, so much good economic news is priced in.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
15 minutes away from an ECB rate decision, 30 minutes away from some important economic data going into the Federal Reserve, a week away. Your scores into all of that look like this. Equity futures just a little bit firmer on the S&P, on the NASDAQ, on a Russell. The small caps outperformer by 0.6% on the benchmark, the S&P 500 up by 0.2%. Your hour ahead, the next 60 minutes looks like this. 8:15 Eastern Time, an ECB rate decision. 8:30 Eastern, PPI and jobless claims. Lisa, 8:45, a news conference with the ECB president.
It's really interesting to me that somehow in this round-trip volatility experience that we've been having this week, we've settled on the idea that the economy actually is fine after all, and that the Federal Reserve can cut by 25 basis points. The ECB has a bigger struggle, but they're also going to cut by 25 basis points, and everything can keep on going swimmingly along. I do wonder when we get a material shift in the narrative, given how much volatility we've got, and given the fact that people seem to settle on this increasingly with a lot of asterisks around every single one of those points.
Things could change again in the next week or so. So Citi were at 50 for next week. They dropped that down to 25. They're saying they could dial it back up to 50 all over again. And this is the note that dropped 15 minutes ago that I promised you. Data over dependence, the title of this piece from Andrew Holmhorst at Citigroup, and it reads like this. An upside surprise to jobless claims this morning, or downside surprise on retail sales next week, could push the Fed back towards a 50 basis point cut. That language, I know you share it. Data over dependence, Mohammed. Is that a good thing or a really bad thing?
I think it's a really bad thing. I think you have to have a more holistic view of the economy. I'm not sure that a weak jobless claims number or a weak retail sales number would push them to 50 at this point. Okay, so I do think it may push the market to expect a higher probability of 50, but I don't think it pushes the Fed to do 50.
I'm interested in the jobless numbers because UBS's Paul Donovan put this out this morning because a lot of people in the market have been really annoyed with the Labor Department and these massive revisions we've seen. And he says, unlike the employment report, these are accurate as they measure reality, not opinions. But jobless claims do not represent everything, of course, that's happening in the U.S. labor market. But I wonder if people actually look at this and say, these are a little bit more accurate and we can take these numbers a little bit more on hand.
You could get the same data and you could get 5 different opinions by a lot of people in the markets in terms of what you should do with it and what the Fed should do with it, which is the reason why a lot of people are calling for maybe some more visible disagreement among Fed officials so that you can get a sense of how their parameters might be different from one another. There are interesting intellectual arguments to be had. The market's trying to hash it out, and what's really coming to the fore is just unprecedented volatility in some of these benchmark rates.
Totality of the data, 4-week average. 230 on jobless claims. 230, no problem here. Nothing to see here in the labour market, apparently. Is that a decent read on things?
Yeah, I mean, 230 is actually a good number. It's actually an excellent number for this stage of the cycle. What's interesting is what if you get a 250 or 260, or what if you get a 210? So I think plus or minus 20 around 230 makes those numbers really interesting.
Don't you think for market participants the labour market is guilty until proven innocent? And for the Federal Reserve officials, the labour market is innocent until proven guilty? Don't we look at these?
That's a really good way of putting it. That's a really good way of putting it.
That's what it feels like. 210, I feel like in this market right now, they'd be like, whatever. I feel like we're ignoring jobless claims anyway. 4-week average is 230, and we're still freaking out about things. Ally Financials come out. They said credit conditions are bad for auto lending. They're more focused on that than they are on, say, jobless claims.
And that's probably because Federal Reserve Chair Jay Powell himself had the same kind of weighting in terms of they would welcome no further deterioration of the labor market. So does that mean that an additional 20,000 jobless claims could potentially sway them in terms of understanding the trajectory of this market? And I think that's sort of what a lot of people are disagreeing on at a time when everyone's expecting this weakness. The question is just the pace.
Jobless claims, 8:30 Eastern. Let's get you some price action. Equity futures on the S&P 500 still just about positive, up by 0.2%. In the bond market, yields bleeding a little bit higher, up a single basis point. The 10-year 366.46, and going into the ECB, the euro against the dollar, virtually unchanged, 110.15 on that currency pair. Coming up this hour, we'll catch up with Mike Schumacher of Wells Fargo on why the market is still pricing in too much easing. Pooja Kumar of TD Securities saying the ECB is likely to cut by 25 basis points per quarter. And Lindsay Piegza following US jobless claims and PPI data at 8:30. We begin with the big issue. Traders slashing expectations for a half-point cut at the Fed meeting next week. Mike Schumacher of Wells Fargo writing CPI nearly locks in a 25 basis point cut by the Fed on September 18th. The market still prices too much easing. Fade it. The Fed ultimately could deliver even more easing. However, that almost certainly would require a series of downbeat economic numbers over the next 3 months. Mike is with us for more. So, Mike, let's get into it. You say fade it. What are you expecting? How big is the gap between you and market pricing?
It's come in a bit, John. So if you look at the pricing, let's say through the end of the year, the market's got about 100 basis points of easing priced in. Figure 25 next week's pretty much locked. So 75 basis points incrementally. So think about it as a 25 and a 50. I'm not convinced that 50 is done. So the market, in my opinion, should probably move down to call it 90 basis points. I think that would be fair. It's moving the right direction. It's been fairly quick about it, but it's not there yet.
So take us another 6 months where the market is pricing in another 100 basis points of cut. So what do you see the next 12 months look like?
Yeah, it's interesting, Mohammed. So if you think about the next 12 months, the market's priced for what? 225 basis points, 230, something like that. Very much in line with historical cycles. What I think is interesting here, though, is if you look at way out in the forwards and think about the terminal rate, the market's got that about 280. So it's by no means a particularly easy response, if you will. It's still actually above the Fed's long-term target for Fed funds. So it tells me that the odds of a hard landing in the Fed's eyes have tipped higher, but they're not terribly high just yet.
Can you reconcile what you see in what we just talked about with what we see in the credit market and what we see in credit spreads in particular?
Credit has held in incredibly well, in my opinion. I'm surprised default rates have not picked up. I understand it's a bit of a lagging function, but still, we've been waiting for a while. So that's been, I'd say, exceptionally strong, very resilient so far. Demand's been heavy. I think part of that, though, in terms of spreads, not defaults, but shifting over to spreads, is there's been so little carry available in rate markets. In other words, the yield curve has been inverted for so long. Now, if you look at Treasury 2s, 10s, it's flat. I see that. But investors have been forced to go elsewhere to pick up yield, to pick up carry. Consequently, investment-grade credit's benefited. I think that's been one thing helping spreads.
There is this larger question, just to build on what Mohammed was talking about whether different markets are disagreeing with one another, about whether the rates market is talking about recession and pricing in serious weakness, and you're seeing credit markets, you're seeing equity markets really point to ongoing resilience. Do you see it that way?
I think markets can look at different cues for sure, and you've got investors with all sorts of different objectives. But in the end, and maybe it takes a few months to happen, they've got to coalesce around one sort of macro view or one set of macro variables. So at this point, Lisa, it seems to me that market participants are still trying to gauge, is inflation still back in the box? Is it really not something we should worry about too much, and should we shift entirely to the jobs market and growth? I think most people are migrating that way, but they're not entirely there yet. And if the equity market tends to get much more fixated on growth, then you can see a lot of choppiness in some of the high flyers as we've seen recently.
You know, I was struck yesterday when first we got the CPI print. We were surprised that equities actually fell, even as people priced out a 50 basis point rate cut. It should be positive, and I thought that good news was good news. Then we had this wild ride where NVIDIA just took over, but I am wondering whether there was any signal there from your perspective.
It did seem to us it was one big trade for quite a while, so the market was locked onto NVIDIA, if you will. The correlations were super high. We were looking at various FX pairs. My colleague Jeff Shore tracks it night and day, and you could see high correlations even from FX to NVIDIA. It didn't make a tremendous amount of sense. It's faded now, but I'd say for 24, 48 hours, that was a driver.
Mike, before we run, what's the call on the FX market going into this ECB in a few minutes' time?
The ECB is going to deliver not much, frankly, John. And I think as far as FX goes, we think the euro is going to weaken. So take euro dollar down to 108, 107, something like that over the next month or so.
Okay, 110.14 on euro dollar right now. Mike, thank you. Mike Schumacher there of Wells Fargo. Just want to pick up on Lisa's point around the CPI print yesterday. Anna Wong of Bloomberg Economics. Reach out to Anna and get some of the research from them, because this quote jumped out for me from the team yesterday. The continued price declines in core goods categories, even as freight costs have risen, suggests firms are having difficulty passing higher input prices onto consumers. That portends further margin compression down the line, with the possibility that firms resort to layoffs to cut costs. The mix in inflation yesterday, problematic for Anna and the team.
You start to look under the hood and you saw that the pop, the sort of one nugget of surprise, came from housing costs that some people say are skewed to the backward looking. A little bit more highlights maybe why this is viewed negatively, why it's too much of a good thing. You want disinflation, but not too much. And that's, I think, what we saw.
Every time you get a backup in yields, those yields get bought pretty quickly, and we saw it repeatedly in yesterday's session. Equity futures right now positive by 0.2%, a little bit of a lift. The ECB rate decision is 5 minutes away. Let's take just a brief moment, an opportunity to get you an update on stories elsewhere. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Unicredit's Andrea Orcel told Bloomberg that a full takeover of Commerce Bank is indeed an option after building a 9% stake. Orcel said he was surprised that the German government was caught off guard by the move, that they had been aware of Unicredit's already existing position when it purchased more shares from the government. Resistance is already building from Germany's powerful unions, while people familiar say Commerce Bank is preparing defensive options. Alaska Air shares higher in the pre-market trade by about 4.8%. The airline boosted its outlook. Alaska also noted lower fuel costs as oil prices drop. It highlighted a stronger than expected month of July thanks to other airlines that couldn't fly during the CrowdStrike disruptions, as well as strong performances in August and September. Experts are watching for signs that Taylor Swift's endorsement of Kamala Harris in the 2024 presidential race could energize millions of her fans to hit the polls in November. The first indication of her influence may come from those who registered to vote at her urging. Swift's custom link to vote.gov drove more than 300,000 visits to the site as of 11 a.m. Wednesday. That's according to the General Services Administration spokesperson. And that's your brief, John.
Danny, thank you. Danny back with us again in 30 minutes' time. Up next on the program, an ECB interest rate decision from New York City. You're watching Bloomberg TV.
we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep Green World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
So the stage is set. 8:30 Eastern, we get jobless claims and PPI. In about 1 minute's time, we get an ECB interest rate decision. And the scores going into all of that look like this. Equity futures on the S&P 500 up by 0.2%, closing yesterday on a 3-day winning streak on the S&P 500 and looking to make it day 4. On the NASDAQ, we just had our biggest day of gains on the NASDAQ 100 since the middle of August. And you can thank Jensen Huang over at NVIDIA. That's the equity market. If we check out the bond market, we look like this in the Treasury market. 2-year, 10-year, 30-year. Basic yields up a single basis point. The 2-year, 365.58.
Not necessarily incredibly changed after yesterday's CPI print, with the expectation squarely on the Fed cutting rates by 25 basis points next week.
The 2-year up a single basis point. The 10-year as well to 366.27. And one final look at euro dollar going into this interest rate decision. Widely expected the ECB to cut by 25 basis points. The euro at 1.1011 and basically unchanged on the session. Waiting for the ECB then, the previous rate on the deposit rate facility was 3.75. The survey, in our survey, we're looking for 3.50. Often they're a little bit late. Waiting for that decision, Lisa, with euro dollar at 110.16. Still waiting for that that ECB rate decision. Why are they all so late compared to the Federal Reserve?
We now are getting a decision. And frankly, we're getting some other headlines saying that they're going to keep the deposit facility rate. They're going to cut it by 25 basis points to 3.5%. That was the estimate, John.
Waiting for some headlines then. I'm waiting for the statement to come up on the website from the ECB as well. It's good to see the Europeans have got their act together in Frankfurt, Germany, isn't it? Yields are higher by 3 basis points on a 2-year at 2.17. On a German 10-year up a single basis point to about 2.11. We were looking for 3.50. We got 3.50. The previous rate was 3.75. We're looking for some guidance now, Lisa, from the ECB, and we are looking for some forecasts as well.
Yeah, what is interesting is they're talking about inflation rate, the inflation outlook really determining this, seeing the growth forecast actually as lower for every year through 2026, seeing inflation in 2026, ex-food and energy at 2%. So this isn't necessarily because they see inflation coming down, and seeing next year inflation, just cutting out food and energy, coming out at 2.3% versus 2.2%. So even though they are seeing the growth outlook deteriorating, even though they did cut rates, they still see inflation as stickier over the longer term than on the margins than perhaps they previously thought.
A meeting-by-meeting approach from the European Central Bank versus what we might see from the Federal Reserve next week, where we could get some real guidance about a string of interest rate reductions. The approach from the ECB, very different to what we are expecting from the FOMC.
And commentary like this, they expect to keep rates sufficiently restricted as long as needed, a very different type of commentary than you heard from the Federal Reserve. A question around how much this really does hinge with sticky inflation and the single mandate that this central bank really has.
Let's cross over to Lizzie Burden on the ground in Frankfurt, Germany at ECB HQ. Lizzie, your first take this morning, please.
Well, this is exactly what was expected by economists and markets. Another cut from the ECB. The background is that you've got inflation receding. As they say, the economic activity remains subdued in the euro area, the risks around that mounting. But you've also got a focus on the path ahead. So as you point out, the forecast's really interesting here, trimming their forecast for growth, not just this year, but the years ahead. And this is precisely why Jens Hatzius has trimmed Jan Hatzius has trimmed his forecast so that he actually sees consecutive cuts at the meetings ahead, not just quarterly, specifying the growth outlook, manufacturing weakness, the weakness in Germany. So that'll be where the questions focus in the press conference, John. Interesting that they haven't changed their inflation forecast. They see it returning to 2% by late 2025. It's still the same there. It'll be interesting to see at the press conference whether Christine Lagarde emphasises the need to react to the growth risks more so than the inflation risks, because that would encourage traders on the outlook ahead. But I expect, as the language is here in the guidance, that she's going to want to keep her options open.
And Lizzie, I want to just build on that, and that was something that John identified. This is very meeting by meeting. This is not necessarily some prescriptive path like the one that we're hearing more from the Federal Reserve or expecting to next week. At what point will you start to get consensus around ECB members that they need to prioritize growth if they do believe, as Goldman Sachs laid out, that the ultimate neutral rate is near 2% and ultimately inflation is going back to that target?
Well, first of all, you've got to agree where the neutral rate is, and by no means do they agree that it's at 2%. There's a whole spectrum from 2 to 3%, and actually, the likes of Isabel Schnabel have been saying that it's going to get harder to agree on the Governing Council the closer and closer they get to that rate. It doesn't mean that it's going to be any easier in the near term, but look, there is so much divergence on the Governing Council. Don't be fooled by this decision that they voted for the 25 basis points. There is so much divergence and concern about the risks ahead and where that neutral rate lies.
Lizzie, thank you. Lizzie Burden there of Bloomberg on the ground at ECB HQ in Frankfurt, Germany. This and the outlook. Staff continue to expect a rapid decline in core inflation from 2.9% this year to 2.3% in 2025 and 2% in 2026. There's going to be plenty of questions today about why they still need to take a meeting-by-meeting approach and aren't communicating something a lot more powerful about reducing interest rates further from here.
Especially given the fact that they're cutting growth forecasts for every year through 2026. At a certain point, if they see inflation falling precipitously, even if maybe falling to slightly above where they previously thought next year, why won't they take a more aggressive approach to support growth? And does that mean becoming more of a dual mandate type of central bank akin to what the Fed does?
The euro totally unchanged, euro dollar right now, 110.16. Mohammed alongside us. Mohammed, your thoughts on this decision?
So let me frame the question slightly differently to everybody around the table. Why is it that they're still worried about sticky inflation if they've revised down their growth projections? I think that is the key issue, and that I hope someone will ask Madame Lagarde about what is it in the inflation outlook that is proving particularly sticky and worrisome for the ECB.
Let's ask Pooja Kumra of TD Securities that question right now. Pooja, welcome to the show. I'm sure you heard that question from Mohammed. Your thoughts on it, please.
Oh, thank you. So yes, ECB as expected right now, and I think as you mentioned, this is the key question. If they are seeing inflation to be a target in 2025, why this slow approach? I think from ECB's perspective, the question right now is basically the wage inflation, and which is actually standing at 5.1%. And this is much above what we have seen in the 2019 level, which was around 2%. So far, Lagarde has always talked about this WPP model, which is wages, productivity, and profit margins. And I think that's where she will be asked, is productivity actually increasing that can help to reduce these wages, which doesn't seem the case right now. So I think, yes, definitely a very key question for Lagarde right now is, if you are seeing inflation at target, why is this 5% wage inflation still being so sticky, and why are they not cutting rates more aggressively?
In your WPP, she will be speaking today in the context of the Draghi report. And the Draghi report basically says without major policy actions that aim at improving the way the economy functions, there are no productivity gains that can be sustained. Do you agree with that view?
Yes, right, totally. I think even when you look at the weakness in Germany, it's more of a structural weakness and not a cyclical weakness. So ECB cutting rates does not help German growth. And I think I do agree with Draghi's model on that we do need that investment, that productivity coming from Europe. But we also know that that's a long process. That cannot happen in one day. And I think ECB at this stage really needs to think about, do they just go by the survey data, which are basically suggesting that wages will reduce aggressively in 2025-26, or they stick to the current hard data, which tells you that wages are very sticky?
What do you think would happen in markets? And I'm wondering about the market reaction function in addition to the ECB reaction function. What would happen in markets if Christine Lagarde came out and talked about a more aggressive rate-cutting path, particularly at a time where the euro is baking in sort of the Fed and the ECB moving in tandem?
So again, if they tell us more aggressive path, yes, the front end rallies. We were pricing in 1.5 rate cuts, so possibly going closer to 2. But we also know the time until the October meeting is basically 5 weeks. So there's nothing much that's changing right now from ECB's data perspective. So I think they would have a big downside risk to growth at this meeting, which doesn't seem the case when we read the statement. So I doubt they are going to be very open about the October cut, but what is more likely is ECB sounding more optimistic about reaching the inflation target, especially given the fact that global growth is actually a negative right now across the board, especially when we look at US and China, which means markets should start pricing more cuts and more aggressive form of cuts in 2025 and pull forward this neutral rate, which is around 2%.
Pooja, how difficult is Lagarde's job in the sense that inflation is quite different whether you look at Central Europe or the periphery?
Yeah, no, that is the key issue for ECB. I think when it comes to ECB, they do have to take Europe as an aggregate. So even if German growth is minus 0.3, they still need to actually look at the entire euro growth, which is still above stagnation. So this is a tricky job. As long as financial conditions are sane across the board, which has been the case since 2020, I think ECB will not go country by country, but look at the total target. Because even like when you said, in Europe, wage negotiations work very differently from country to country. So they cannot actually say by October they'll have the right number of wages for the entire euro area. So I think they do need to work more on surveys and Europe as a whole.
Pooja, we've got to leave it there. We appreciate it. Pooja Kumran there of TD Securities following an ECB rate cut of 25 basis points on the deposit facility. We'll hear from the ECB president herself, Christine Lagarde, in about 20 minutes' time. Lisa, the ECB goes 25.
Mohammed asked the key question, which is essentially if they're downgrading growth, why is inflation still a preeminent concern? And I don't have the answer, and maybe Christine Lagarde does.
I'm sure she will, written down on a sheet of paper that she might read out a few times in this news conference.
100%.
So you're going to be one of them for an hour.
Basically, how can you message nothingness over an hour at a time when people want real answers?
That's the promo for the news conference, 8:45 Eastern on Bloomberg TV. Coming up next, breaking PPI and jobless claims. We'll get reaction from Lindsay Piegza of Stifel and Michael Schau from New York. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Looking for the economic data to come out on time in about 20 seconds. Here in the United States, looking for jobless claims and PPI. Equity futures going into that. Futures positive 0.25% on the Nasdaq 100, up by 0.2. On the Russell, the small caps up by 0.4. In the bond market, 2-year, 10-year, 30-year, shaping up as follows. The yield curve just a little bit lower at the front end of the curve by not even a basis point. The 2-year 363.72. On a 10-year yield, we're at 364.96 with your economic data. Let's cross over to Mike McKee. Good morning, Mike.
Good morning, John. Well, if you were betting on a very low jobless claims number, you got it, 230,000. That's barely up from a revised 228 the week before, so no movement really seen there. The PPI comes in up 0.2, a little stronger than expected for the headline, 0.3, also stronger than expected for the core, and 0.3 for food and ex-food, energy, and trade. So all of the PPI numbers a little bit stronger than expected. However, on a base effects reason, the final demand year over year, 1.7%, food and energy, 2.4%, and ex-food, energy, and trade, 3.3%. Basically, all the same as anticipated by economists. The 1.7% is the lowest for the year-over-year headline PPI since February. That's down from 2.2%. So it's sort of an inline group of economic data this morning, and they basically say to the Fed, go ahead, whatever you want to do.
Which is probably going to be 25 based on what everyone's saying at the moment. Mike, thank you, sir. Before this number, the 4-week moving average on jobless claims, Ian Ligonabimo pointed this out, was 230, and the number this morning is 230. PPI comes in just a little bit hotter than expected, month over month, like CPI just yesterday, and this is the price action, the price reaction in the market. Equity futures still positive by 0.1% on the S&P. In the bond market, yields inflect just a touch higher, Lisa. At the front end on a 2-year, up just a single basis point.
There were no big surprises here, and I think that the idea that we were talking about earlier about how this market is primed for some sort of the wrong kind of upside surprise and initial jobless claims, and if we don't get it, status quo. Until we get it, it's sort of everything chugging along, and that ultimately was the key number that came out, given that PPI doesn't have that same kind of correlation with some of the key inflation metrics the Fed watches.
Let's get some more reaction to this and cross over to Lindsay Piegza of Stifel. Lindsay, your thoughts on the data this morning, the data yesterday this morning, and how this sets us up for the Federal Reserve next week?
Well, I think coupled with yesterday's hotter than expected read on the core CPI, this morning's slightly hotter than expected read on the PPI, it's not enough to negate the Fed's intentions to open the door for rate cuts next week, but it is a welcomed reminder of the Fed's ongoing focus on inflation, as price stability is not yet met. And with this lingering uncertainty, unevenness in terms of the disinflationary trend, I think this underscores the Fed's need to remain on a very patient, tempered approach as we do embark on this policy pathway back towards neutral. Now, the market has seemingly removed the expectations for a larger, more aggressive 50 basis point cut next week, but I would argue it was never really on the table. If the Fed did take that more aggressive move, I think that would send the wrong signal to investors, or investors would interpret that incorrectly as the Fed maybe taking an intention to rapidly reverse us back to an accommodative stance. But at this point, with the economy still solid, slowing, but still solid, I think the Fed's intentions is simply to remove policy firming and get us back to a more neutral state in terms of policy.
So, Lindsay, let's go beyond next week. I completely agree with you. The Fed has been stressing to the market we are a dual mandate central bank, and the market has been responding, no, you're not. You're a single mandate central bank, and the employment part is critical. So now that the data has reminded us that they should remain a dual mandate central bank, how do you see the rest of the curve, in particular what's priced in all the way out to September of next year, evolve in the next few weeks?
Well, I do think investors got ahead of themselves, and I think the downward momentum that we've seen on the longer end does have some wiggle room, some room to reverse course, not necessarily push us back to earlier highs that we saw at the start of the year, but certainly gain at least 10, 20 basis points on the 10-year, putting us back into line with a more realistic pathway of the Fed's trajectory back to neutral. Again, I do think a base case is 25 basis point cuts, and not necessarily at every meeting. The Fed is going to remain data dependent, and if we see inflation stumble for back-to-back months, as we saw in yesterday's and today's reading, I think they're very likely and very willing to skip a meeting. And so I do think that, again, the market's expectation for this rapid reduction back to neutral or even falling below the neutral range by mid of next year is well beyond what the Fed is realistically willing to do.
Lindsay, what in the specifics of the inflation data gives you pause about just how much inflation is coming down? In other words, what are the sticky components that you worry most about?
Well, one of the biggest worries is the housing component, and we saw that in yesterday's CPI report, one of the primary drivers of that hotter than expected read. If we continue to see the shelter component rise or rise above expectations, given the sizable weighting that housing has, not just in the CPI, but even in the PCE, that's going to be very difficult for the Fed to maintain a 2% target or achieve that 2% target on a sustainable basis. So housing is one of those very sticky components that we're focused in on. That being said, even when we do strip out housing and we look at one of the more narrow measures of inflation, the super core, so we're talking core services excluding housing, we still see that that's a read above 4%, so more than double the Fed's intended target. So there are still a number of underlying components and underlying measures that are not yet cooperating quite as much as the Fed would like, as they are nearing, presumably, that first round rate cut next week.
Lindsay, we've got to leave it there. Appreciate it. Lindsay Pierce there of Stifel, waiting for that rate cut, which most people assume will be 25 basis points. Michael Schau joins us now of Ion Asset Management. Michael, good morning to you, sir.
Good morning.
Base case at the moment, the Doves won't get their 50. Can they achieve the same outcome by leaning very heavily on the dot plot?
Yeah, I mean, I think we'll probably see a big dispersion in the dot plot. You know, at this week's meeting, I think that's the way that people are going to really say, you know, we think we should be doing more, or we think we should be doing less. And then the sort of third part of this is which way is Jay Powell going to lean when he talks publicly following the meeting? Is he going to be, you know, pointing towards the Doves or you know, more in the middle of the pack?
So two follow-up questions immediately. One is, given your expectations of more dispersion, are we right to look at the median, thought or not? And second, isn't it obvious which way Chair Powell is going to lean?
I would probably say no and no. It's really not clear, you know, which side is going to really dominate. I think it's not clear exactly who the Doves are and who the Hawks are. I think Powell sensibly is trying to steer a middle path between both bodies, and I think he's happy to jump ship to the left or the right, depending on what, you know, he's probably the most data-driven part of the Fed.
You think it's unclear what he says, or it's unclear how much they cut by?
Oh, I think he'll be very clear. He'll be very clear that he doesn't know exactly what they're going to do, and he's going to wait until he gets the information to tell him what he should be doing. I mean, that's, I think he's going to be very clear about that. But what the outcome is going to be extremely unclear.
We were talking earlier about how this Federal Reserve doesn't have this sort of overarching framework of the destination and the journey that we have going forward. I wonder if, as an investor, you do. Can you have that clarity if you don't get it for them with this sort of conviction that the Fed will ultimately follow whatever it is that you're seeing that is not with any extra data that everybody else doesn't have?
No, I think the Fed, all things being equal, is going to start to cut and is going to put us on a path for a gradual easing. But the bigger question in my mind is what's actually happening in the underlying economy. And when you see members of the Fed almost having to make up words to describe it, there's that long piece using the term equipoise. You know, it's a very weird environment. So
I noticed that John Williams has got a thesaurus. I thought the same thing.
Yes, I was impressed. I was going to say equipose is somebody who tries too hard to make a point. Maybe I shouldn't. Anyway. You know, it's a very strange economy because a lot of the strength that we had, a lot of the overheating that we've had has gone away, but it hasn't really been replaced by any obvious weakness. The labor market I haven't seen a labor market like this with no real underlying growth, no real power to it, and yet absolutely no deterioration. And initial claims yet again this week confirmed that nobody's hiring, but nobody's firing. So it's really the way that gets resolved that ultimately matters much more than what the Fed does. The Fed is going to be responsive to that outcome. I don't think it's going to cause it one way or the other.
I'll attempt to be direct then. What are you buying?
I still think precious metals come out here. I think they're the way that you play a policy mistake. I think, you know, if the Fed is a little bit too on the easy side and tries to get ahead of things, I think precious metals really are the winners.
The policy mistake then, just to be very clear, is them easing too much?
Correct.
Interesting. Michael, thank you, sir. Michael Schau of Ion Asset Management. Long precious metals.
Two arguments back to back in why inflation is not dead and why you can't discount it, essentially. And even if the Fed does, that is still something that's preeminent in markets.
Is President Lagarde going to make the same argument in 5 minutes' time?
I'm guessing probably not.
Let's see. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Just a quick recap of that ECB decision. They cut their interest rates by a quarter percentage point to 3.5%, as expected. The central bank also cut its growth forecast for every year through 2026, noting subdued economic activity. It did keep its inflation outlook unchanged and reiterated that it can't commit to a specific rate path. As you mentioned, John, we're going to hear from President Christine Lagarde in just about 5 minutes' time. Intel is wrapping up 3 days of meetings where the chipmaker is reviewing its strategy in what's been a dismal year for the company. Bloomberg is reporting that final decisions are not expected at the meeting itself, but eventual options include scaling back multi-billion-dollar factory projects, selling off subsidiaries, or even splitting Intel's core operations into separate companies. Shares of Intel have fallen 60% year to date. And more turbulence could be ahead for Boeing. The plane maker's 33,000 union members are voting today on whether or not to strike when their current contract expires at midnight. New CEO Kelly Ortberg urged members not to strike, warning that a work stoppage could negatively impact recent efforts to turn around the company after a challenging several years. And that's your brief, John.
Danny, thank you. Thanks for this morning. Up next on the program, an ECB President Lagarde news conference just around the corner from New York. You're watching Bloomberg TV.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
So the opening bell, 9:30 Eastern Time, about 45 minutes away. Before we get there, an ECB news conference with Christine Lagarde begins in about a minute from now. Equities at the moment, just about unchanged, a positive 0.1% on the S&P 500. Lisa, the 10-year down a basis point, 364. PPI a bit hotter, jobless claims, let's call it in line at 230.
This hasn't really shaken the market's assumption that the Fed is going to be cutting rates pretty aggressively. And I'm just still thinking about what Michael Sowell said, that essentially this market is mispricing how much inflation has fallen away, especially with some of the hotter than expected prints. I'm watching break-even rates falling to some of the lowest rates we've seen since the end of 2020.
Mohammed, what's your big takeaway this morning? What's the big takeaway for you?
My big takeaway is never insult Italy. If you're anywhere near John Ferro.
It's a good one.
That's my big takeaway.
That's the takeaway from earlier in the programme.
That is my big takeaway.
What were your thoughts about how outspoken the Germans have been over the last week or so on all manners of issues?
I am not going to get you.
You brought it up. I don't know.
Well, they've been
opinion.
outspoken, though, about what Draghi said. Do you think Draghi's plan is good?
No, I think actually Draghi. Embraces the 80 and doesn't look at the 20 as much as it should. Europe completely embraces the 20 downside and forgets about the 80 upside.
This was the point Draghi was making on tech.
I'm laughing because essentially you're trying to lead Mohammed to say something negative about the German reaction function to
No, I think
what he's saying.
he basically said it about the European bureaucracy.
Well, he talked a lot in much more diplomatic terms, but that was sort of what he was trying to get to you.
I wasn't going to ask questions about the difference between sort of Italian culture at banks versus, say, French and German, and why the German Labour representative seems to think they have more in common with the French banks than they do the Italian banks. I wasn't going down that road.
Will you go down the road of AC Milan should be owned by a German?
I think it should be owned by a Frenchman. I know. I said that repeatedly.
Because he wants nice
AC Milan
uniforms.
should be owned by the richest person in Europe. No debate about that. I've got no problem with that at all. As long as they've got deep pockets, Mohammed, I'm not bothered. That should be the same approach to acquisition, shouldn't it?
What?
As long as they've got big plans, great objectives, and deep pockets, should you care where they come from?
Well, I just have a question for you. Does that sort of erode some of the Italian spirit of AC Milan?
Are we interviewing me or Christine Lagarde? What's happening?
Well, Christine Lagarde, maybe she can weigh in about our no, and whether she also sees potential for AC Milan.
Let's cross over to this news conference where the ECB President Christine Lagarde kicks off things this morning. From New York City, good morning. Here's the ECB President, Christine Lagarde.
We're also joined by journalists via remote connection. So when you take the floor, I would ask you to turn on your cameras and your microphones. And with that, I would like to hand over to President Lagarde. President Lagarde, please.
Thank you very much. Good afternoon. So the Vice President and I welcome you today to our press conference. The Governing Council today decided to lower the deposit facility rate, the rate through which we steer the monetary policy stance, by 25 basis points. Based on our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission, it is now appropriate to take another step in moderating the degree of monetary policy restriction. Recent inflation data have come in broadly as expected, and the latest ECB staff projections confirm the previous inflation outlook. Staff see headline inflation averaging 2.5% in 24, 2.2% in 25, and 1.9% in 26, as in the June projections. Inflation is expected to rise again in the latter part of this year, partly because previous sharp falls in energy prices will drop out of the annual rates. Inflation should then decline towards our target over the second half of next year. For core inflation, the projections for 24 and 25 have been revised up slightly as services inflation has been higher than expected. At the same time, staff continue to expect a rapid decline in core inflation from 2.9% this year to 2.3% in 25 and 2% in 26. Domestic inflation remains high as wages are still rising at an elevated pace. However, labor cost pressures are moderating and profits are partially buffering the impact of higher wages on inflation. Financing conditions remain restrictive and economic activity is still subdued, reflecting weak private consumption and investment. Staff project that the economy will grow by 0.8% in 24, rising to 1.3% in 25 and 1.5% in 26. This is a slight downward revision compared with the June projections, mainly owing to weaker contribution from domestic demand over the next few quarters. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. We will keep policy rates sufficiently restrictive for as long as necessary to achieve this aim. We will continue to follow a data-dependent and meeting-by-meeting approach to determining the appropriate level and duration of restriction. In particular, our interest rate decisions will be based on our assessment of inflation outlook in light of the incoming economic and financial recovery to strengthen over time as rising real incomes allow households to consume more. The gradually fading effects of restrictive monetary policy should support consumption and investment. Exports should also continue contributing to the recovery as global demand rises. The labor market remains resilient. The unemployment rate was broadly unchanged in July at 6.4%. At the same time, employment growth slowed to 0.2% in the second quarter, from 0.3% in the first. Recent survey indicators point to a further moderation in demand for labor, and the job vacancy rate has fallen closer to pre-pandemic levels. Fiscal and structural policies should be aimed at making the economy more productive and competitive which would help to raise the potential growth and reduce price pressures in the medium term. Mario Draghi's report on the future of European competitiveness and Enrico Letta's report on empowering the single market stress the urgent need for reform and provide concrete proposals to make this happen. Implementing the EU's revised economic governance framework fully, transparently, and without delay will help governments bring down budget deficits and debt ratios on a sustained basis. Governments should now make a strong start in the direction of their medium-term plans for fiscal and structural policies. Looking at inflation now. According to Eurostat's flash estimate, annual inflation dropped to 2.2% in August from 2.6% in July. Energy prices fell at an annual rate of 3% after an increase of 1.2% in previous month. Food price inflation went up slightly to 2.4% in August. Goods inflation and services inflation moved in opposite directions. Goods inflation declined to 0.4% from 0.7% in July, while services inflation rose to 4.2% from 4%. Most measures of underlying inflation were broadly unchanged in July. Domestic inflation edged down only slightly to 4.4% from 4.5% in June, with strong price pressures coming especially from wages. Negotiated wage growth will remain high and volatile over the remainder of the year, given the significant role of one-off payments in some countries and the staggered nature of wage adjustments. At the same time, the overall growth in labor costs is moderating. The growth in compensation per employee fell further to 4.3% in the second quarter, the fourth consecutive decline, and ECB staff projected to slow markedly again next year. Despite weak productivity, unit labor costs grew less strongly in the second quarter, by 4.6% after 5.2% in the first quarter. Staff expect unit labor cost growth to continue declining over the projection horizon, owing to lower wage growth and a recovery in productivity. Finally, profits are continuing to partially offset the inflationary effects of higher labor costs. The disinflation process should be supported by receding labor cost pressures and the past monetary policy tightening gradually feeding through to consumer prices. Most measures of longer-term inflation expectations stand at around 2%, and the market-based measures have fallen closer to that level since our July meeting. Let's look at our risk assessment. The risks to economic growth remain tilted to the downside. Lower demand for euro area exports, owing, for instance, to a weaker world economy, or an escalation in trade tensions between major economies, would weigh on euro area growth. Russia's unjustified war against Ukraine and the tragic conflict in the Middle East are major sources of geopolitical risk. This may result in firms and households becoming less confident about the future and global trade being disrupted. Growth could also be lower if the lagged effects of monetary policy tightening turn out stronger than expected. But growth could be higher if inflation comes down more quickly than expected and rising confidence and real incomes mean that spending increases by more than anticipated, or if the world economy grows more strongly than expected. Inflation could turn out higher than anticipated if wages or profits increase by more than expected. Upside risks to inflation also stem from the heightened geopolitical tensions, which could push energy prices and freight costs higher in the near term and disrupt global trade. Moreover, extreme weather events and the unfolding climate crisis more broadly could drive up food prices. By contrast, inflation may surprise on the downside if monetary policy dampens demand more than expected, or if the economic environment in the rest of the world worsens unexpectedly. Financial and monetary conditions. Market interest rates have declined markedly since our July meeting, mostly owing to weaker outlook for global growth and reduced concerns about inflation pressures. Tensions in global markets over the summer led to a temporary tightening of financial conditions in the riskier market segments. Overall, financing costs remain restrictive as our past policy rate increases continue to work their way through the transmission chain. The average interest rates on new loans to firms and on new mortgages stayed high in July at 5.1% and 3.8% respectively. Credit growth remains sluggish amid weak demand. Bank lending to firms grew at an annual rate of 0.6% in July, down slightly from June, and growth in loans to households edged up to 0.5%. Broad money, as measured by M3, grew by 2.3% in July, the same rate as in June. To conclude, the Governing Council today decided to lower the deposit facility rate by 25 basis points. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. We will keep policy rates sufficiently restrictive for as long as necessary to achieve the same. We will continue to follow a data-dependent and meeting-by-meeting approach to determining the appropriate level and duration of restrictions. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium-term target and to preserve the smooth functioning of monetary policy transmission. And we are now ready to take your questions.
Thank you, President Lagarde. And the first question goes to Annette Weisbach of CNBC. Annette, please.
President Lagarde, thank you very much. I have a question, of course, on the decision to cut by 25 basis points versus 50. So why did you go for 25? And my second question is looking into the future, given that the Fed also is going to start to cut. The macroeconomic picture is gloomier than before. Inflation is coming back. So what is the market right to anticipate that you cut another 50 by the end of the year? Thank you.
Thank you so much, and good afternoon, and it's nice to see you all after the break, first of all. So on your question about our decision, we decided to cut the deposit facility rate by 25 basis points, and that was a unanimous decision. We proceeded as we normally do and have very clearly indicated by obviously looking at data and looking in particular at data through the prism of our three key criteria. So when you look at the incoming information, it confirms our previous projections, and it comforts us in our confidence that we are heading towards our target in a timely manner. So during the course of 25 in particular, inflation will decline towards our 2% target. And we thought that given that gradual disinflationary process, it was perfectly appropriate to moderate the degree of monetary policy restriction by cutting our deposit facility rate, which I will call the DFR, if you don't mind. From now on, it's the deposit facility rate, by 25 basis points. When I said that we looked at all the information that we get on the occasion of a projection exercise through our 3 prisms, I'm referring obviously to the inflation outlook, I'm referring to the underlying inflation, and I'm referring to the transmission of monetary policy. And, you know, on the inflation outlook, when we receive the projections of our staff for September, it's virtually unchanged relative to June for the inflation outlook. And it continues to see a return to 2% before the end of 25. And this is, by the way, the 5 consecutive projection exercise pointing to that 2% at the end of 25. So why do I say that? Because it certainly reinforces our confidence in the solidity and robustness of those projections. That's for the first prism, the inflation outlook. The underlying inflation, on the other hand, we look at the various indicators that we have, from domestic to PCCI, and here we see one particular indicator, the domestic indicator, which is abating a little bit because it moved from 4.5 to 4.4 between June and July, and it is not satisfactory. It is resistant, it is persistent. This is the reason why we have to be resilient in our approach and very attentive to the various components of core inflation as measured by those various indicators. The third prism is the policy transmission. And on that front, we all observe that the financing conditions continue to be restrictive, and the footprint of our monetary policy in the real economy has been visible. So, on the basis of that review of incoming data, staff analysis, consistency of the projections for the 5th exercise in a row, that decision to cut by 25 basis points was perfectly legitimate and, as I said, unanimously decided. I drink to the future. Well, future, I'm tempted to quote, Spanish, que será, será. Because we have consistently said, and we repeat again, that we shall remain data dependent. And that is particularly justified in view of the uncertainty that abounds. So we shall be data dependent. We shall decide meeting by meeting. And our path, of which the direction is pretty obvious, a declining path, is not predetermined, neither in terms of sequence nor in terms of volume. And I would like to add one thing which I have already said before, which is still true, which is that data dependency does not mean data point dependency. We're not going to be fixated on one single number. We are looking at a whole battery of indicators. And I'm saying that in particular because September will certainly deliver a low reading of inflation, very likely. We expect, because of the base effect, particularly on energy, our inflation numbers to be up in the 4th quarter, so the last 3 months of 24, but September is going to deliver a low reading. But we're not just looking at one indicator. We're looking at a whole range of data that we receive.
Thank you, Madame Lagarde. And the next question goes to Francesco Canepa of Reuters. Francesco, please.
Thank you very much. Good afternoon, everybody. The October meeting is a short 5 weeks away. So to use your own words from March, do you think you will know a lot more or just a little more come October 17th? Second question is about something else. It's about something that ECB has been championing for years, and that is cross-border consolidation between banks. It seems it's finally happening with UniCredit building up a stake in Commerzbank. So does the ECB welcome this development?
Thank you very much for your two questions. On your first questions, we can all count. It is 6 weeks before October 17th, which is a relatively short period of time compared to other intervals that we've had in the past. I would simply repeat what I have said. We are going to be data dependent. We are going to decide meeting by meeting. I'm not giving you any commitment of any kind as far as that particular date is concerned. And our path is not predetermined at all. On the other matter that you referred to, typically we do not comment on individual institutions. And as you know well, we have a clear procedure which involves our supervision authority, the SSM, which at certain thresholds of equity ownership or transfer of shares, if you will, has to be consulted, has to authorize. And of course, I'm confident that the authorities of these institutions concerned, namely UniCredit and Commerzbank, will be perfectly aware of their regulatory requirements and will comply with such requirements. The SSM will do what it has to do in full independence, and clearly cross-border mergers have been hoped for by many authorities, and it will be very interesting to see that process unfold in the weeks to come.
Thank you. And the next question goes to Mark Scheuers of Bloomberg. Mark, please.
Yes, thank you. The first one, you said again that the rates needs to be sufficiently restrictive for some time. How many times can the ECB cut interest rates before they are no longer sufficiently restrictive? So basically, where do you see the so-called neutral rate? And the second one is more on the effect of interest rate cuts. How much of a boost could such cuts deliver to the euro area economy, given that at least some, if not most, of the problems are structural? Thank you.
I'm going to thank you for your two questions. I'm going to spend a bit more time on your second question, because on the first one, how long are we going to be sufficiently restrictive? Until we have been sufficiently restrictive. Because what we want is to achieve the goal of returning inflation to target in a timely manner. As I said, for the fifth projection exercise, we have inflation at target during the second half of 2025, and that is on the basis of the baseline that we have in our projection. And we're going to observe how that baseline evolves over the course of time as data comes in to decide for how long we have to continue cutting rates and at what point we have been sufficiently restrictive. So I'm not going to give you any idea as to where our star is, because this is an unobservable concept anyway, and we will, as we get closer to it, we will know certainly better. As you probably know, staff has produced a very good paper on our star, which indicates that it's probably a tad higher than where it used to be. But I'm not endorsing this. I think, as I said, as we get closer to it, we will know better whether we are there, and there are multiple factors that are going to impact on that. Now, your second question. Is this 25 basis point cuts going to be a boost for our economy, given that so much is structural? So, I know I'm preaching the converted here, but obviously there is a lag between the time when we make a decision and the impact is actually felt and can be observed in the economy. What we are still observing at the moment is the impact of our tightening decisions from more than a year ago, almost 2 years ago now. This continues to have an impact. We believe that the peak has been reached in relation to GDP, but there will be continued, although downward sloping, effects of those decisions, and we will have the same kind of lag applying to the decision that we are making now. So that's point number one. The passing of time does not satisfy the instantaneous satisfaction that we would have to see the results coming out of our decisions. This is the reality of monetary policy and the functioning of our economies. The second part of my answer to your question, because you do refer to structural causes, gives me a chance to actually commend the Draghi report. You know, we haven't had time to dissect everything, neither has anyone for that matter, because it's sufficiently substantive and material enough to require more time and special attention. But it's a formidable report in that it poses a diagnosis which is severe, but which is just, in our view. And it also points to structural reforms, practical proposals to achieve such structural reforms that could be extremely helpful for Europe to be stronger, but also for us as central bank to achieve better results in our monetary policy. If productivity can rise as a result of the structural reforms, for instance, that would be very good news for us. If the capital market union can be implemented and more financing be made available in order to finance innovation, that is good news for us as well when it comes to inflation, price stability, and the components that underlie this work that we do.
Thank you, Madame Lagarde. And the next question goes to Aude Kersulek of BFM TV. Aude, please.
Thank you for having my question, Madame Lagarde. Are you worried about the risk of below target inflation? In France, INSEE estimates that inflation will be 1.6% in December, and we can add that oil prices are at the lowest since COVID, so is it a risk? And second question about the Mario Draghi's report. Can it have an impact on monetary policies on the ECB's mandates? Thank you.
As you will appreciate, I'm not going to give you an answer that is country-specific because we work on a euro area basis. But obviously it's a risk that we have to be attentive to, which is why we are targeting that 2% sustainably. Has to be asymmetric in the medium term, as we have anticipated in our strategy review, which remains completely valid. You mentioned two things. You mentioned one thing in particular. You mentioned energy. Well, energy has been one of the key factors that took prices up, directly and indirectly through all sorts of channels. And in the same vein as it took prices up, it is helping to move prices down. Well, this is an exogenous matter, and this is one, that can move again, and that we have to be prepared for. The second question you ask is, and I think I have partially responded to your question, some of the proposals in the Draghi report, as well as in the Letta report, by the way, because achieving the single market and improving the competitiveness in our view can be very complementary. But some of those proposals touch directly on what we are specifically concerned about. And the Capital Market Union is one in particular on which the Governing Council has had a strong view and issued a special opinion upon. In the same vein, the financing of innovation, the increase of productivity, the competitiveness in relation to its external position, all of that actually matters when it comes to the work that we have to do. I didn't see in Mario Draghi's report any suggestion that the mandate of the ECB should be modified. We have a single mandate, as you know, which is price stability. We comply with the treaty and with the mandate that was given by the founding fathers of Europe, and hopefully we can, not hopefully, but we will deliver on that mandate. And whatever is suggested by Mario Draghi has a lot more to do with structural reforms. And I very much hope that the executive authorities in charge will actually take it to heart and will see a path towards those structural reforms.
Thank you. Turning to the remote participants, I'd like to give the floor to Martin Arnold of the Financial Times. Martin, please.
So Martin is still with us?
Today.
Ah.
Anyway, hello, President Lagarde. Two questions from me, if I may. Firstly, I'd like to ask about services inflation, which the latest reading showed went up again. How much concern does that give you? And what do you see as the risks going forward on that, as you've raised your forecast slightly for core inflation? And the second question, if I may, is back on the Draghi report. Does the ECB intend to adjust monetary policy in any way to facilitate implementation of Draghi's proposals? Thank you very much.
Well, thank you so much for your two questions, and thank you for pointing to this services inflation, because that is clearly the component of prices that requires very attentive understanding, monitoring, and I'll come to that in a second. But suffice to say that it went up from 4.2 to 4.4. So whereas so many other components are on a declining path, that particular segment is increasing. And we've tried to decompose what is behind it, and it's a combination of holiday packages, insurance, and I'm trying to remember what is the third one. I'll come back I'm sure it will come back, but it's predominantly these two. We are looking attentively to the nexus of three elements. Number one, wages. Number two, profits. Number three, productivity. And services is particularly sensitive to wage increases. So our expectations is that services inflation will decline over the course of 25. Why? Because what staff had anticipated, which is moderation of wages growth, buffering of wages cost by slightly declining profit, and increase of productivity is actually being demonstrated by numbers, by observations. If you look at wages, whether you look at compensation per employee, whether you look at negotiated wages, whether you look at unit labor cost, all of that is going down. Wage tracker, same thing. And our expectations is that it will continue to go down in the course of 25. We will, on negotiated wages, we will still have relatively high numbers, and we know that some are in the making at the moment. The auto workers unions, the IG Metall request, and in various other countries, but with some heterogeneity, will continue to move wages higher in the first half of 25, but then it's definitely on a decline path. It is already the growth is on a declining path, but it will pick up again in the latter part of 24, very early in 25, and then it will continue to decline. And the numbers that we have for growth in wages, I will share with you. I've got my unit profit growth. So I'll give you the number later if you're interested, but it is definitely declining. That's on the wages. On profit, we are now observing from high numbers that we had at the end of 20 up until the end of 23, we are seeing declining numbers on profits. And as a result of that, you can obviously deduct that profits are actually buffering and absorbing some of these labor cost increases. On productivity, it is also on a declining path, moderate and not it's on an increasing path as considered and envisaged by staff, a little less than what they had projected, but it's also heading in the right direction. So that really confirms the views that they had taken initially, and that has given us confidence that services will move downward as well, that wages growing moderately and more moderately now, profit absorbing more wages, and productivity increasing a little bit by virtue of, cyclicality, will lead us to having services prices less than where they are at the moment. But it's obviously a sector that is, as I said, which is resistant and on which we have to be very attentive. You had a second question, if I remember, and I'm trying to... Oh, yeah. Mario Draghi's report includes so many important structural reforms that are going to be the responsibility of governments, that will require the leadership of the Commission and the leadership of those leaders in Europe who are determined to strengthen Europe, to give it more sovereignty, to give it more capacity in the current geopolitical circumstances, that I'm really certain that monetary policy will do what it has to do, which is to provide price stability and to deliver on its mandate, while structural reforms are not the responsibility of a central bank. They are the responsibility of the governments.
Thank you, Madame Lagarde. And staying with the remote participants, I'd like to give the floor to Silvia Berzoni of the Italian TV channel Class CNBC. Silvia, please.
Thank you very much, Wolfgang. So good afternoon, President and Vice President.
Good afternoon.
I will have two questions, if I may. The first one is, were you expecting such a slowdown in German economy, and how does it factor in your projections and balancing of risks? And the second one, I would like to go back on Unicredit Commerzbank. So in compliance with all the prudential requirements and buffer, do you believe that the emergence of a pan-European bank could be a positive for the industry as a whole and Eurozone? Thank you very much.
Our staff provides projections, goes into real in-depth analysis of the situation of every country, and receives the feedback of the National Central Bank. So they don't provide projections, or they don't provide analysis in the vacuum of the wonderful main building and Euro Tower of the ECB. We do reach out, we do work together on a Eurosystem basis. And the slowdown of the German economy was certainly anticipated by the Bundesbank, certainly the ECB as well, and shared on a Eurosystem basis. So it's embedded and included in the projection that we have. And we analyzed that very carefully with members of the Governing Council in the last couple of days, because there is clearly heterogeneity amongst various countries. When you look at countries separately as they come together to form the system, you see, for instance, that at the moment, Spain or the Netherlands are delivering strong GDP numbers, while at the other end, Germany is on the other side. Your other question about pan-European banks, I think there are quite a few pan-European banks. What you're talking about here is more a cross-border merger between two large national institutions. And that is something which, as I said, will be reviewed from a regulatory standpoint, and which certainly will satisfy many of those who have expected cross-border mergers to result from, banking union when it is achieved. So,
thank you. And the next question goes to Christian Siedenbiedel of Frankfurter Allgemeine Zeitung. Christian, please.
Yes, thank you very much. You emphasized that one part of the decision with the deposit rate was anonymous. Were there other parts of the decision that weren't anonymous?
What part of the decision? We had extensive discussions on all the data that we received, all the analysis that was produced by staff. And, we tested the rationale behind the current recovery, which is moderate, and the pickup in recovery that we expect in 25 and 26. And I think we were convinced that while consumption is low and has actually weakened, it should economically result from the combination of higher net income, fading monetary policy impact, and low inflation. It should necessarily result from those forces that consumption and investment actually pick up. So we tested all that, and we discussed, and some tend to be a bit more pessimistic, some are more optimistic, but we really discussed in depth the rationale behind those outlook numbers that we have for 24, for 25, for 26. And the reason why we revised by 0.1% only, is really a combination of reduced net export numbers, given the uncertainty and the geopolitical risk that we have going forward, and a carryover of the situation that we have now, which is reduced activity because consumption has been lower than we had anticipated. But as I said, we are going to assess each and every time along the way all the data that come in and see that we continue to reach our target in a timely manner.
Thank you. And the last question today goes to Andres Stumpf of Expansion. Andres, please.
Thank you, Madame Lagarde. I have two questions. I have one about the projections. On the one hand, we have no changes in the inflation side, but on the other hand, we have our revision in growth outlook caused by a weaker internal demand, which is the main contributor to inflation. How does this add up? And the other question is, I saw you welcome Mr. Escrivá, the new governor of Banco España, and I was wondering if you could tell us your first impressions and what do you expect from his contribution to the governing council. Thank you.
Thank you very much for your two questions. So you are correct that our projection numbers for HICP, which is the headline inflation, have not changed a bit. They are the same as in June. We haven't revised. The one that we have slightly revised is core inflation. We have revised core, which takes out energy and food by 0.1%. Well, we have revised 24-25. We have not revised 24-26. And that is caused by what? By the fact that energy prices have significantly impacted downward and have benefited to the headline inflation. The fact that food has slightly increased but very little. And as a result of these two components, there's a bit of a trade-off and a net-off, if you will, with other prices, notably services. Now, we have revised downwards the outlook for growth because the consumption that we had anticipated for now, essentially, because net income has begun to increase, inflation has gone down significantly, and we were expecting consumption to pick up, has not picked up. And I think that we will be looking at that carefully when we produce our next growth and GDP numbers. José Luis Escrivá has joined the circle of the governors, and we have greeted him, we have welcomed him in the circle of governors. Like other governors, he has made some very useful contributions, and I hope, like any other governor, he will continue to not only give his personal views, and which might be inspired in part by the Spanish situation, but he will have this European dimension that other governors also have when they sit around the table of the Governing Council. And it is a process, and it's a journey that I hope will be productive and pleasant, both for him and for the group of governors around the table. But I can assure you that he was welcome, and he was contributing.
Thank you. That concludes our press conference. Thank you very much for participating. The next press conference will be on 17th of October, and that will be the external Governing Council press conference, which will take place in Ljubljana in Slovenia.
Yeah.
Thank you very much.
That was ECB President Christine Lagarde. Let's get over to Bloomberg's Lizzie Burden at the ECB in Frankfurt. And Lizzie, I want to ask first about her comments on growth. I'm watching here the FTSE, the CAC 40, the DAX. They've all trended lower and lower and lower, given up their gains for the day. Is there a growth scare in Europe?
I thought it was interesting that the inflation outlook didn't have a particular bias, but there was one on growth, Matt. She says that the risks to growth are tilted to the downside, whereas for inflation, there's no change to the forecast. For growth, they've changed their forecast lower for this year and the years ahead. So that's notable. It's a difficult outlook to navigate as they go ahead. She's talked about this meeting being unanimous on the Governing Council, but behind the scenes, we know that they're divided over where the neutral rate lies. She wouldn't comment specifically on where she thinks it is, though she said it would be simpler to know as they get towards it. And it's no surprise, therefore, that she didn't want to give anything away about whether there's going to be an October cut. She says it's going to be data dependent, meeting by meeting, and they're not fixated on a single number, she says. So don't go crazy, is what she's saying to traders, if inflation drops in September, because it could rise again.
All right, don't go crazy, Lizzie Burden. Really appreciate your reporting. That's Lizzie Burden at the ECB in Frankfurt, of course, after the bank cut rates by 25 basis points, but was clear on the future path not being predetermined. Meanwhile, let's get over to U.S. markets. The U.S. market has been open for about 7 minutes, and stocks are searching for direction after that big reversal we saw yesterday. The S&P 500 currently flat, a little bit higher right now, maybe if you're an optimist. Same thing, too, if you take a look at the NASDAQ 100. Of course, NVIDIA saved the day yesterday, really leading that rebound we saw on the NASDAQ 100, on the S&P 500. The Russell 2000 is your leader at the moment. The small cap index currently up about 0.5%. Meanwhile, some stocks to keep an eye on at the open. We have shares of Alaska Airlines soaring after the company raised EPS and profit expectations for the current quarter, riding a wave of strong travel demand and lower fuel costs. Meanwhile, Delta sees adjusted EPS for the full year above $6.50. That is in line with previous estimates. Shanali.
I'm also keeping an eye, Katie, on Moderna, which plans to reduce its research and development budget by almost 20% over the next 3 years. The company is struggling with profitability as vaccine sales disappoint, Matt.
Yeah, and Oxford Industries is lower after the apparel company cut its annual adjusted earnings per share guidance to a level below the average annual analyst estimate. I should say Oxford owns Tommy Bahama.
Yes.
I just took off a shirt to put on this suit.
Thomas Bahama.
And Lily Pulitzer. Is that still a big thing?
For some people.
Yeah.
Certainly a thing. It exists.
I mean, my daughter has a Lily Pulitzer onesie.
There you go.
You know.
Yeah.
And how old is your
She's
daughter?
10 months old. Let's take a closer look at retail costs and sentiment with Bloomberg's Abigail Doolittle. Abby, what do you got?
Well, we continue to have this bifurcation amid the consumer investors trying to figure out whether or not we have a strong U.S. consumer or a weakening U.S. consumer. Both may be true, and it depends on where you look. So Walmart, you can see over the last 2 months, up about 14% on the year, up even more. So that big box discount retailer, better prices, really doing well. In large part, we've been hearing stories about people with higher incomes recently shopping there for food. Procter & Gamble, good quarter recently. They raised the growth looks good for some of their essential products. But when we go discretionary-wise, Urban Outfitters, July and August started to weaken. They're expecting that may continue into the second half. And just yesterday, designer brands, over the last 2 months, down 30%. They put up a bad quarter. This is, of course, the owner of Keds and DSW. So it really seems as though discretionary is not doing as well, whereas Staples still hanging in there. If we connect this to consumer sentiment, because, of course, consumer sentiment will be out tomorrow, if we go into the Bloomberg terminal and take a look at what's happening here, well, actually, we don't have that. But what we do have is the bifurcation right here between that split between discretionary in orange, up about 7% on this year, so not so shabby. But take a look at Staples and the S&P 500 up closer to, let's call it 16 to 17%. The big question is which side is quote unquote right, Katie? Which side is more accurately representing the consumer? We, of course, don't know that right now, but 66% of the economy, it's super important to watch. And, of course, for directions of stocks.
And, of course, we'll get another clue tomorrow. Abigail Doolittle, really appreciate that. Let's keep the conversation going now with iCapital Chief Investment Strategist Anastasia Amoroso joining us on set now in person. Great to see you.
Great to see you, Katie.
So Christine Lagarde just finishing up, of course, the ECB press conference. Compare and contrast her tone with what you're expecting to hear from Jerome Powell next week.
Yeah, I think it's quite different. What really strikes me is that Christine Lagarde seemed a lot less concerned about growth and a lot more concerned about inflation, and which is quite different, and I would say quite the opposite for the Fed, because the Fed is more concerned about the labor market. But, you know, she was really, I mean, there's really not much attention given to the growth outlook, which is weakened. And, for example, for this quarter, just 0.3% annualized growth that's expected. You know, you would think that if this was in the United States, you'd have a pretty big reaction to that, but it's not the United States. You know, the other thing is she is quite concerned about inflation and hence the lack of willingness to pre-commit to the future path of rate cuts, I should say. So it is going to be meeting by meeting. It is going to be, even though she said don't pay attention to particular data points, but it is going to be, you know, watching the data points like inflation. And if the consensus estimates prove to be right and inflation does grind lower towards, I think, 2.3% by the end of next year, that will produce a series of rate cuts. And this is so different from the Fed, because Fed Chair Powell has said that, well, we have a lot of room to work with, you know, when it comes to where the nominal Fed funds rate is, where inflation is, where the neutral rate is, and we're overly restrictive. So the Fed seems to have a greater willingness to move than the ECB.
Now let's talk about what's going to move the market as well. Is it really what's going to happen with the Fed at this juncture when you see kind of single names? NVIDIA yesterday really turned around the market here. You're looking at NVIDIA today trying to notch its 4th day of gains. Let's see if they can get there. It's been kind of staggering in the early trades. Is it really the AI trade when you see a day like today where almost all of the Philadelphia Semiconductor Index is dragged down once again?
Yeah. Well, I think there are two main stories or maybe questions that the market participants are trying to game out. The first one is, are we headed into a recession or are we not? And that's why you've seen the defensive sectors like utilities, for example, really outperform since about the middle of July. And I think this tug of war of data is going to continue, where we get a data points a little bit weaker. Oh no, we're going to recession. You get another one, and that sort of erases that fear. So, you know, so that's why I would expect the defensives to continue to provide the anchor and the pillar to the markets. But at the same time, Shonali, I do look very closely at the semiconductor space. And, you know, look, what happened to semiconductors, the valuations got very extended relative to the S&P, for example. The ratio was 1.4 times. Utilities, by the way, were quite cheap to the S&P. And so that has started to reverse over the last several months. So semis have come back down to earth in terms of valuations. They're not quite in line with the S&P. They're still expensive relative to their 10-year averages. But if you look at the multiple adjusted for growth on semis, it's actually below the long-term averages. So I think investors need to look at that very closely and say, well, do they expect the growth in semiconductors to continue?
And what I heard from a lot of the Goldman Sachs tech conference reports, whether it was NVIDIA, whether it's Marvell, whether it's Broadcom, they are continuing to see very strong demand for artificial intelligence. And I think one of the reasons why NVIDIA, had the standout day yesterday was because they also talked about how much additional rental revenue the hyperscalers can generate, if they invest in NVIDIA chips. And so that ROI, I think, is so huge for the industry right now. And we seem to have it, so therefore that should support the investment cycle into semis. So despite the weakness, I think investors should be looking at this space and adding to it.
I looked at the intraday swings, and Jess Menton put together a chart for us to show on the S&P how big they are. Yesterday we had the second biggest intraday swing since 2022, and if you look at the chart, we're getting bigger groupings of bigger swings. Are we going to see this kind of volatility through September 18th? Does it go until November 5th? I mean, what is going to, calm this market back down?
Yeah, I think, plus or minus 1 month before and after the Fed rate cut, or maybe even extend that to 3 months before and after. I think it's normal to see elevated volatility because of what I mentioned earlier, is we're trying to figure out where the economy is headed. I think it's going to become clear where the economy is headed more so in the next 3 months, especially once some of those rate cuts start to filter through. So that's the first thing. The second thing is, election certainly has a role to play. And if you look at the manufacturing numbers, for example, manufacturing activity has slowed down quite a bit, particularly the new order component. And I think that has something to do with the election, because if you are a company trying to invest in property, plant, and equipment, do you know what the rules are going to be? Do you know what the tax code is going to be? Do you know what the tax incentives are going to be? The answer right now is probably not. It's going to depend on the election outcome. So I think that's part of what's also producing this volatility in the equity market. And we also see this when we look at the Republican outperformance baskets, the Democrat outperformance baskets. So, Matt, I think there's a lot for markets to parse through, and that's what they do on a daily basis.
Anastasia, we thank you so much for your time. That is iCapital's Anastasia Amoroso, in the middle of what's been a lot of volatility in these markets heading up to the election. Now, coming up, a double downgrade for Micron Technologies. We're going to tell you what's behind that call next in Top Calls. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
As
we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
All right, it's time now for Top Calls. Some of the analyst action in focus this morning. And first up, BNP Paribas double downgrading Micron to a sell rating and slashing its price target nearly in half. The firm says that Micron will underperform its AI peers through 2025 thanks to an oversupply and impending correction in the chip memory market. Next up, Wolf Research is upgrading Roku to a buy. The firm says that sales at the streaming video platform poised to accelerate from here. And remember, earlier this week, Wells Fargo's raised its rating on the stock thanks to the potential of its Roku channel. And finally, we have Stifel cutting its rating on Simon Properties, saying that the stock is no longer a buy. The firm says that the company has outperformed the sector this year and cautions that shares could lag in the near term, Matt.
All right, coming up, junior bankers are getting their hours capped at JP Morgan in a good way. That and more on our Wall Street Beat. This is Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
This is Bloomberg Open Interest. Let's take a look at where stocks are trading, of course. About 23 minutes or so into the U.S. trading day, you can see we've now reversed lower on the S&P 500, the NASDAQ 100 too, but we know that we've seen a lot of volatility in this market. This stat coming from Bespoke Investment that the last time the NASDAQ was down 1% intraday, which happened yesterday, but finished the day higher by over 1%, was on the bottom in October 2022. So we'll see what happens from here, Shonali, but right now, stocks are lower.
They sure are, and it's time now for the Wall Street Beat. We're going to talk about working conditions. Two of Wall Street's biggest banks are rolling out measures that may ease junior bankers' workloads. This comes after complaints about long hours, increasing complaints. JP Morgan now plans to cap hours for junior bankers at 80 hours a week. Bank of America, meanwhile, says it will monitor closely individual workloads. We are joined now by Catherine Doherty, Bloomberg's finance reporter, who has been covering this story really for the last couple of months. These calls have been building. There is a difference this time around. A couple of years ago when we saw the junior banker revolt, let's call it, it was about pay. It was at a time of a deal boom. This time around, deal volumes are coming back, but the nature of these complaints are somewhat different, aren't they?
They are, and the real question will be, are there changes that stick? Are there changes that actually make a difference after we hear these complaints? Because complaints are not new. They come up time and time again. As you mentioned, pay was one moment in time, but this whole issue and the tensions around the type of working conditions, the hours that bankers are working, the lack of sleep, their health that is deteriorating because of that. This is something that is not new on Wall Street. Veterans will say this is part of the game and that you have to put in the work in order to earn your space in the industry. And so now what we've really seen is pushback from the junior bankers and some really very important moments in time at Bank of America. One of their bankers passing away after working on a very large M&A deal, and that really sparked an outcry, regardless of really the rationale and the reason behind his passing. It just brought up a whole new conversation, renewed the conversation about working conditions. So now what you're seeing is the banks actually putting into place some changes. So for JP Morgan, capping the hours at 80, and for Bank of America, they're improving their system. So instead of reporting hourly workloads every week, the bankers will now be putting in their hours each day so that it's accurately tracking, or more accurately tracking, the type of work that they're doing.
All right, Catherine Doherty, really important reporting. Appreciate your time, of course, on that story that JP Morgan and others looking at ways to cap junior banker hours. Meanwhile, you take a look at markets right now, again, to the downside. Of course, we've seen massive volatility in the last week or so. Really, the whole month of September today is no different, to a lesser degree, but the S&P 500 searching for direction right now, and right now, Matt, finding it to the downside.
All right, coming up in the next hour, Nimrit Kang joins us explaining how she is taking advantage of this market volatility that we've been talking about. And the co-CEO of TickPick discusses dynamic ticket pricing and transparency. This is Bloomberg.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see, is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is did you take the tumor out? And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Thursday morning from the Bloomberg Interactive Brokers Studio in New York City to our worldwide audience. We are also streaming live on YouTube, so check us out there. You can search Bloomberg Podcast, and that's where you'll find us. We're going to speak to Michael McKee, Bloomberg Economics Editor here. Get his thoughts on this inflation print we got today from the PPI. Hugh Worthington, he's going to join us, Bloomberg Intelligence European rate strategist, because we had the ECB cutting rates today as expected. Where do we go here with our European Central Bank friends? Priya Misra, fixed income portfolio manager at JP Morgan. We're going to get her market call ahead of the Federal Reserve, which is likely to move next Wednesday on rates. But first, let's go to Lisa Mateo. We'll kick this whole thing off. Lisa.
You got it. Market Drivers brought to you by Interactive Brokers Portfolio Analyst. Consolidate and analyze all your financial accounts on one powerful dashboard for free. Sign up for a Portfolio Analyst at ibkr.com/free PA. All right, more economic data for investors to consider today. We had U.S. producer prices rose slightly more than forecast in August. That was thanks to a rebound in the cost of services. PPI for final demand increased 0.2% from a month earlier after a downward revision to July's reading. And weekly jobless claims rose 2,000 to 230,000 last week, above estimates, above the prior week. Continuing claims, they also rose. Later today, we'll get data on household net worth and also the U.S. Treasury's monthly budget statement for August. Let's get to the reaction. So we have the NASDAQ little changed up about 13 points. The Dow up down 0.4%, 183 points. The S&P 500 down 0.1% or 9 points. The 2-year yield at 3.65%. That's little change. The yield on the 10-year 3.67%, and that's up 1 basis point. Some companies making news. UniCredit, its CEO said all options are open for Commerce Bank, including a possible takeover. And then we'll stick with banks. There were complaints about long hours, so sources say JP Morgan plans to cap junior bankers' hours to 80 per week, while Bank of America, well, more closely, they're going to monitor their trainees' workloads. And finally, Microsoft cutting 650 jobs in its Xbox unit, according to a memo to employees. Those shares down about 0.4%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul and Alex.
Thanks so much, Lisa Mateo. I'm Alex Steele alongside Paul Sweeney. That banker story is one that I definitely listened in when Paul was describing your week and weekend, and I was like, I don't know, man, that just sounds terrible.
We got used to it, number one. Number two, everybody else we knew was doing the same thing. The one thing that really bummed me out, because I would manage my work schedule so that I could get out, particularly in summer, maybe like 5 o'clock on a Friday. I'm all geared up, and then some knucklehead vice president or director drops a book on my desk and says, I need the LBO model by Sunday midday. And you're like, oh, man.
And you're like, this is over. And you can't like do it at the beach. It was not a remote working situation at that point. Yeah, that was tough stuff. All right, if you're in San Francisco, for your listeners, starting October 1st, the place to listen to us in the Bay Area is on the Bloomberg Business app. It works seamlessly in your car with Apple CarPlay and Android Auto. Make the switch today because October 1st, Bloomberg Radio is streaming directly to your phone. The Bay Area's new home for Bloomberg Radio is the Bloomberg Business app. Download it free at the App Store or on Google Play. So market's kind of chilling for a little bit, and I say that because yesterday was crazy in terms of the whippy action that we saw. I was just reading Charlie McGilligott's note over at Nomura, and he's like, it was NVIDIA. It was not macro, it was not eco. This was the NVIDIA central bank power that it has to just sort of move everything else along with it. Today, there are some very dramatic movers as well. So Norma Linda joins us from Bloomberg News. One is Moderna, worst performing stock in the S&P.
Worst performing stock here. We are seeing shares of Moderna falling for their lowest level in more than 10 months. That's ticker mRNA. Now, this company pushed back its goal of breaking even by 2 years. That's from 2026 to 2028. And it said that it's discontinuing 5 programs in its pipeline and slowing some late-stage studies of certain treatments that it had. And the CFO said, we are still dealing with a market of uncertainty. We hope that will settle out this year, but we have to brace ourselves just in case vaccination rates continue to go down.
This stock is now the lowest since September of 2020. I mean, you look at the chart for Moderna, it's just
it's really tough.
Even worse than when I last looked.
Yes.
Yeah, and it's tough also because they need the money and you need to issue debt or equity in order to R&D, right? Like it all kind of matters, and they're doing amazing stuff.
They are.
So anyway, yeah, that's a tough one. So Delta, here's a confusing one. So it rose 5% at the open. Now it's down 2%. Talk about whippy.
I mean, yeah, it's fluctuating here. I mean, this is coming after some news that it sees its full-year profit trending higher, despite that tech outage. Of course, everyone was really thinking about CrowdStrike and how that would affect a lot of airlines, including Delta, if you recall back in July when we saw that massive outage. But Delta said that it sees its full-year adjusted EPS at or above $6.50. Previously, it saw between $6 to $7 here. So investors, Wall Street is saying that this is some good news out of Delta, but I mean, we are seeing shares a bit lower here. So it seems that investors are really trying to see what's going on with the stock.
Yeah, but Alaskan Air had some nice commentary, right? They also said strong demand.
The Jerry Garcia airline.
Yes, yeah. And they have boosted their own profit view as well.
Right.
Let's stay in transportation for a moment for totally different reasons. Norfolk Southern.
Completely different reasons. We're seeing shares of Norfolk Southern in focus this morning.
Norfolk.
Oh, did I add it? Did I add an L?
No, that's just the pronunciation for
Norfolk.
Folks, down in Virginia.
You gotta say, and that's funny. I'm from Virginia. This is a shame.
So maybe actually he's right and you're wrong.
No, he's definitely
it's
right.
Like New Orleans. It's not New Orleans. It's New Orleans.
New Orleans. Gotta say it fast. Norfolk.
Yeah.
There you go.
Norfolk
okay, you
Southern.
got it. You got it.
And it's just like it's not Greenwich, Connecticut. It's Greenwich.
Greenwich.
It's definitely not Greenwich. Did we think it was? Did someone think that?
No, I'm just
saying. Were you just saying, like, for
clarification for the listener?
Yeah. Okay, all right.
Exactly.
That's ticker NSC. Now, this company is in focus because it fired its CEO, Alan Shaw. This was an investigation that found that he violated company policies by engaging in a consensual relationship with its chief legal officer. Now, that chief legal officer has also been let go as well. But this company has really been a topic of lots of controversy, especially given the fact that it had that toxic train derailment that we've saw that's been a conversation over the past 2 years, as you recall. And obviously, it's been really in battle with an activist campaign that has really been having all investors eyeing this stock. But I mean, this is some really big news this morning as we're really digesting it here in the market.
All right, Norm, thanks a lot. Really appreciate Norma Linda joining us from Bloomberg News on all the main equity movers of the morning. All right, let's get to the eco data. Charles McGilligott says that's not a moving market, but maybe Michael McKee will disagree, international economics and policy correspondent. All right, so you got the producer prices for August. Mike, did this tell us anything?
Not a whole lot. It tells you that there's still sort of a range-bound inflation level in producer prices, some categories up, some categories down, but it doesn't suggest any major building inflationary pressures, which is what the Fed would be worried about. Interesting thing was that trade services rose 0.6%, a fairly large increase, and that is based on retailer and wholesaler margins. So it's good news for profits, it appears.
Oh, okay. All right, very good. So you take this along with the CPI data. Does this give the Fed greater confidence that they, in fact, have inflation under control here and they can start easing interest rates?
They can certainly start easing interest rates. I think the fact that we saw a little bit higher PPI on a month-over-month basis, a little bit higher CPI core on a month-over-month basis, tells the Fed that they have inflation sort of under control, but it's not, the victory is not won yet, and they still need to be cautious, which puts them on the side of 25 basis points as opposed to 50. Doesn't discourage a cut. But I think that's what the markets are pricing now, is that the Fed has to feel like it needs to be careful.
You know, there's been an argument that if they go 50, then it's going to set up, you know, ooh, what do they know that we don't know, et cetera. When you're talking to people, is that a real argument, or is it like, hey, things are actually okay, let's keep it that way and not mess about and cut 50?
I mean, I think the latter is correct. Nowadays, at least for people on Wall Street who have Bloombergs, the Fed doesn't know anything that you don't know. I mean,
they don't have like some inside super cool track, and they release the data that they have.
You know, they release the data they have. Everybody else has access to the same economic data, and most big banks have analysts who are also talking to CFOs and CIOs and talking to people about what's going on in the companies, so they're getting the same sort of read on the economy on a real-time basis that the Fed presidents get by talking to CEOs. All the Fed banks do surveys on a regular basis of companies in their districts, and you know, that's what the job of an analyst is on Wall Street. So I think everybody kind of has the same information, but they have different motivations. The markets are looking for ways to make more money. Well, the Fed is looking at, was looking at inflation alone, and now they're looking at both sides of their mandate.
Right. So, I mean, again, if you step back here, is there, when you talk to people, Michael, your sources, where are we in just the recession talk that, gee, maybe the Fed's too late, and in fact, you got to pull this recession talk back onto the table. It's been kind of off the table for a while now. Where are we in terms of timing of the Fed and what it means for the U.S. economy?
Almost everybody's cut back their recession forecasts. There are some people out there who, well, there's always the stopped clock folks. You know, at some point we're going to have a recession. And then there are people who think that we are going to, we might have a recession because of previous recession indicators that don't seem to be working this time, and chief among those is the inverted yield curve story. So when you look at the rest of the numbers, and things have definitely slowed, but they haven't gone into recession. Now, the biggest thing about recession is it's a confidence matter. You don't have a recession. People, when you go into recession, people stop spending, and companies stop spending because they have lost confidence in their ability to be able to pay for things going forward. And at this point, that doesn't seem to be on anybody's mind. We'll find out tomorrow what the latest Michigan confidence numbers are, but while those have been down some, they're not down in recessionary territory, and businesses aren't saying we're going into recession. So at this point, it might take some external factor, some geopolitical thing could destroy confidence. After 9/11 yesterday, you remember what happened then. People don't really see it, and the Fed doesn't really see it happening.
Here's my recession data point that I sent to Tom Keene yesterday afternoon around lunchtime, walking from the Bloomberg headquarters on Lexington Avenue over to the park. Beautiful day, walk around Central Park. 60th Street, a bunch of swanky restaurants with outdoor seating, packed. I mean, overflowing packed for lunch. So I'm like, I sent to Tom a message. I'm like, I don't see a slowdown here on East 60th Street, but that's just that. So
that's also tourists and also businesses. So that's definitely a combo. Hey, Mike, thanks a lot. Really appreciate it. Speaking of, though, you have Verizon is announcing a voluntary separation program for about 4,800 eligible employees will separate. They see a pre-tax third quarter severance charge of $1.7 billion to $1.9 billion. Is that like voluntary laying off? Is this what this is?
That's what I view it as opposed to, just...
You're definitely out of here.
You're out.
Like, here's a package, take it or leave it. It'd be super cool if you took it.
We need to lower our costs because our top line, whether it's the wireline business, the wireless business, the fixed wire, it's super competitive out there for those telecom companies.
All right, that's what I thought. Okay, let's get to the other big news of the day, which was actually the ECB cut rates by 25 basis points. The future, though, really questionable. Downgraded their growth forecast through 2026. Inflation, though, still a very big concern for Europe, particularly when it comes to services. Hugh Worthington is Bloomberg Intelligence European rate strategist. I'm looking at a 2-year over in Germany, and bund yields up by over 6 basis points. What was your take? Was it a dovish hike, a hawkish hike? The market is looking like a hawkish hike right now.
Well, cuts, obviously, but yeah, I think we're suffering a little bit of a hangover from possibly the cut that the ECB did in June, which they signalled to the market in April, and then I think basically decided that they probably shouldn't have signalled it quite so soon. And I think some on the governing council were clearly probably not very happy about that. And right now, I think they're very keen not to give too much away as to be pre-committing themselves to do anything in October or even in December. Hence this big focus that the ECB is going to be data dependent, and they don't want to give a strong signal as to what they're going to do next. The one thing I will say about in terms of the move in yields, I think it was I suppose slightly predictable if they did go down this route and decide not to give us too much of a clue as to what they're going to do next. We had a big rally in rates in Europe. 2-year yields down around 75 basis points. Going into that decision over the last couple of months or so over the summer, and expectations for where policy rates are going to be in a year's time are down around 2% now, and they were running at around 3% at the time of the June meeting. So we've had a big expectation from markets in particular that the ECB is going to cut quite aggressively.
Also, what we are covering the portions of Christine Lagarde's speech here, talking about slower growth really for the foreseeable future for Europe here. Give us kind of your thoughts and what you're seeing from your marketplace as to the growth outlook for the EU.
Yeah, I mean, the growth outlook is pretty terrible, really, particularly in core Europe and in particular in Germany. I think the Bundesbank have penciled in growth for 2024 of 0.1%, if you can call that growth. France isn't a great deal better either. But generally speaking, it's pretty sclerotic, the growth outlook going forward. And actually, it got downgraded slightly, again today from those what were previously pretty unimpressive figures anyway. But I think a lot of the focus this week in Europe as well has been on this Draghi report, which is basically focusing on the fact that growth in Europe and in the EU in particular is very much underperforming what's going on around the world, particularly I think underperforming a lot of what's going on in America, and that sort of big reforms are needed. And there's a structural fundamental issue in terms of low growth in Europe, and obviously we're seeing the outcome of that at the moment. And it's interesting actually, obviously with the ECB saying that they want to keep rates in restrictive territory and focus on inflation more than anything. Well, they're not doing much to help that, because I think one of the main things that is driving that sclerotic growth is very poor internal demand, and the one way supposedly they can improve on that is to cut rates and prime the pump a bit. But they don't seem keen to be doing that at the moment.
So, do you think that the ECB is in or headed for stagflation? About 40 seconds.
Stagflation? I suspect not, actually. I think we're probably now a little bit too negative on inflation. I think things like oil prices are coming down, signs of other bits of inflation are coming down. In fact, if anything, there's signs that they may well possibly undershoot on the inflation front. What you might get is inflation playing ball, but as I say, the growth side of things just being remaining very unimpressive, very unexciting indeed.
All right, Hugh, thanks a lot. We really appreciate it. Thank you very much, Hugh Worthington, Bloomberg Intelligence European rate strategist. I was talking to an economist earlier this morning, and basically it's like, look, fiscal spend is all what it's about. Like, if you got high fiscal spend, your growth is going to be okay. You know what Europe doesn't really have? The fiscal spend. That's just super capped, and that's the problem. They don't have a fiscal union. They have monetary union. Anyway, lots more coming up. We're going to talk more with Priya Misra, fixed income portfolio manager over at JP Morgan Asset Management. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got red and green on the screen, and this is after another inflation reading came in a bit higher than expected, and U.S. jobless claims pick up for the first time in 3 weeks. Now, the S&P, it was struggling a little bit to gain some traction, now up about 0.2%. This is after a 3-day rally. It's up about 12 points. We have the Dow, little change, down 28 points. The NASDAQ, up about 0.4% or 78 points. We have the 2-year yield, 3.66%, up 2 basis points. The yield on the 10-year, 3.68%, and that's up about 2 basis points. To currencies, have to point out the euro up about 0.2%. This is after the ECB lowered rates. President Christine Lagarde saying the eurozone risks are tilted to the downside. The euro at 110.38 against the dollar. To earnings we go. Kroger up about 3%, lifted its full-year guidance. That was thanks to consumers prioritizing their spending on groceries. You have Alaska Air up 0.3%. It boosted its outlook for the third quarter. Strong summer demand, lower than expected fuel costs. And Delta down 1%, expects its full-year profit to be at or above the midpoint of its prior guidance, and that's despite the tech outage. And since we're talking airlines, let's go to the company that makes a lot of the planes they fly, Boeing. Their shares are up about 0.2%, but workers, big day, vote today on a new labor contract. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul and Alex.
All right, Lisa Mateo, thank you so much. We appreciate that. Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, so check us out there. Search Bloomberg Podcast, and that's where you will find us. One of the questions I think a lot of investors have, okay, the economy is slowing. I get that. Is that kind of a normalized slowing, or is it something more than that? So let's check in with somebody who has some of these, who thinks about some of the same things, I believe. Priya Misra, fixed income portfolio manager for JP Morgan Asset Management, joining us via Zoom from the Big Apple of New York City. So Priya, when you look at some of the economic data here, is it concerning to you the rate at which the economy is slowing, or does it seem something more normalized to you?
Hi, Paul. Thanks for having me. So that's the key question. And as we're contemplating Fed eases, I think it becomes important what level of interest rates would be contingent or would be consistent with a soft landing. You know, I think the pace of deceleration does concern me a little bit. Now, if the Fed can aggressively take rates to neutral or accommodative territory, maybe that pace of deceleration can slow down. But I still think the data is mixed. You look at the layoff numbers, they're still low. They're not consistent with the recession. But then I look at other things. I look at, you know, the quits rate, the fact that the hiring rate has slowed down. The small business, you know, intent to hire has been slowing now for a while. The housing market's a little frozen. And this pace of, you know, decline that you talked about, I think you could argue it was normalization 6 months ago. Now it's making me a little bit more nervous that this might be something more, but I don't want to say that this is a recession. I think we're in a soft landing right now. The question is, how long can it stay? And can the Fed cut rates quickly enough to allow that soft landing to continue?
So that's sort of what I was asking Mike about, right? Because there is a school of thought that if they cut 50 next week, it's going to mean things are really bad. Or it could also mean that they don't want it to get really bad and that was sort of preempted. What do you think?
I think it's how they message a 50. If they do 50, I think they might go 25. But if they do go 50, I think suggesting that this is risk management, front loading. Governor Waller last week brought up front loading. For the first time, any Fed official has brought it up on the easing side. I think it makes a lot of sense. The risks are clearly skewed to the downside. 6 months ago, we were saying, well, risks are balanced, inflation might be high. Inflation's not a concern anymore. You know, broad-based decline in inflation, notwithstanding monthly volatility. It's the growth side, it's the labor side that's concerning. So if the Fed spins a 50 basis point cut as being front-loading, we're trying to get to neutral faster. And look at the starting point. We're at 5.5 on the funds rate or real rates, given inflation is running about 2%. That's a very restrictive level of policy. So it's how they spin it. I don't think a 50 will be viewed negatively if the Fed says we're just trying to get ahead of the curve or not be behind the curve. But on the same bend, I think if they go 25 and we get the dot plot, and the dot plot suggests that they'll get to neutral sometime next year, I think they can finesse the message and say, look, we've seen the market, we've seen the economy, we're responding quickly. We just think we can start at 25, but if things slow down faster, we can go 50. I think that message the market will need to hear. Otherwise, get ready for a lot of tightening in financial conditions.
So how does one structure a portfolio given kind of that background?
I would say fixed income makes a lot of sense. We've been talking now for a year. When does the Fed start to cut rates? They've told you they're going to cut rates next week. We're debating 25 or 50, but it's starting. Lock in yields. I mean, I think the front end looked very attractive and the Fed might have hiked. You're getting 5% in cash. Well, now if you're getting 6% in a 5-year bond or 7% if you move into high quality, high yield, I would say lock in yields. And I would argue for your end of cycle. We can debate how long that end can last, but active management makes sense. So one of the things we're doing, we're still buying high quality spread product. We think fundamentals are strong in many sectors. So we're not just concentrated in any one sector, but we're also buying duration. We're buying 10-year treasuries. We're putting on steepeners. What if the economy does slow down faster and the Fed lags? The Fed can cut rates, but it takes a while for that to show up in the economy. Interest rates will be a hedge. So I would say that hedged portfolio, own spread product, lock in yield, buy some duration or put on curve steepeners to try and hedge that downside scenario.
Just some breaking news we want to bring it to our listeners. U.S. sanctions Venezuela court chief and election officials. This is over that July 28th presidential election that is questioning, that many, like the U.S., are questioning the legitimacy of that election that elevated Maduro again to the head seat there. Just earlier today, Spain voted to recognize the opposition leader, Edmundo Gonzalez, challenging Nicolas Maduro's election in July. And Venezuela was not happy about that either. So U.S. sanctioning a Venezuelan court chief and election officials. Priya, what's the question? How do you look at neutral? So like we can obsess over next week for sure, and what to do short term. But what do you do longer term if we don't know what neutral is going to be? What if it's 4? Is it 2 or 4? That's a huge difference.
It is. Now you're at 5.5 right now. So I think we have time to figure out neutral. And the fact that growth is slowing, despite all the fiscal easing, despite the fact that financial conditions are easy, tells you that monetary policy is restrictive. So if I go back to basics and I look at R-star estimates, they're all over the place, but it's somewhere between 0 and 1%. Inflation close to 2%. So I come down to around 3% with a wide error band. I mean, maybe it's 2.5 to 3.5. But I think this is why the Fed might have the luxury near term. They can cut about 100 basis points and see how the economy is responding. And it's not just neutral rate. It's also availability of credit. It's financial conditions. It's everything else that go into conditions that help the economy. And then they can decide, are we getting close to neutral? So I think they can finesse that neutral. It's unobservable. To your point, it's extremely important and we can't observe it. But we can look at data and see how it's responding to interest rates. But I would say somewhere in that 3%. But I think what's fascinating is the market's not pricing in accommodative. Despite the fact that the recession talk is in the air, the end point after all the rate cuts, so look at the totality of rate cuts, is around 3%. So the market's essentially telling you the Fed's going to get to neutral and that's going to be enough to keep the soft landing going. I have a bit of a question there. If the lags are long or the Fed is slow or the economy is actually decelerating faster in terms of underlying, maybe the Fed will have to go into accommodative territory, so below 3%. Right. But I think we're going to figure that out as time goes on.
All right, Priya, thank you so much for joining us. Really appreciate it. Priya Misra, fixed income portfolio manager, JP Morgan Asset Management in New York City. Well, some of the news on the Bloomberg Newswire that's getting a lot of readership today is about 2 of Wall Street's largest investment banks are rolling out measures that may ease junior bankers' workloads amid complaints across the industry that weekly hours are increasingly creeping past 100 hours per week. Sri Natarajan joins us. He covers all the big investment banks. He's a senior finance reporter for Bloomberg News. He joins us here in our studio. Sri, so I guess bankers, they've always been known, particularly the junior bankers, for working long hours. And I know that kind of during the financial, during the pandemic, that became a recurring issue of concern. Where are we today in terms of having to try to ease some of the workload for some of those junior bankers?
I mean, what you're saying is deja vu all over again, right? Yep. It just feels like we come back to the same topic every few years. not a surprise that it's often tied to the time when we are starting to see an upswing in deals. The last time this did become a big issue was back during the pandemic. Remember the phase probably a few months after the pandemic when companies suddenly needed this massive funding needs. All the investment banking firms were working overtime on that. That turned into deal-making opportunities, and then you had the 2021 SPAC boom and whatnot. And that viral presentation out of Goldman Sachs and those junior bankers that really caused a stir in the industry. What happened back then, you had pay rises across all of Wall Street. All the firms were raising their base salary for their junior bankers. And these are kids right out of college who in their first, second, third year are standing to make $200,000, $300,000 at these firms. It's become part of the conversation again, because there has been an uptick in deal after a bit of a lull for a year, 18 months. And then there was an unfortunate incident at Bank of America where one of the junior investment bankers died, and people have tried to draw a connection between the reason for his death with the workload that he had. We don't know if there can be a direct connection established, but at least that has sparked conversation again. And you're seeing some of the result. The Wall Street Journal was just the latest news outlet to report on this fact that Bloomberg and everyone else has been talking about for a few months now. Everyone's talking about these rising workloads. There is tension and strain, and banks are being forced to respond. Here you have JP Morgan coming out with sort of trying to fix some hours for its junior bankers for the first time ever. Bank of America already had that, and it's trying to do a better job of enforcement. When you read the fine print, though, and when they talk about some exceptions, when they talk about, well, except when there are live deals, then you have to sit back and wonder. It's not that people were logging 80-hour weeks and 90-hour weeks and 100-hour weeks just twiddling their thumbs. They were probably doing it when there were live deals. So will this really change anything, or will we be having the same conversation 2 years from now?
Well, also, I was reading, I forget where I read it, but that higher banking officials will just tell their junior bankers, like, just don't log the hours. Like, work, but don't log it. Like, you get around the requirements, no?
And that's been a problem. Either people are working longer than the hours that they're supposed to, and just to not get their bosses in trouble, which is a thing. They will try and log less than the number of hours they're working. In some cases, junior bankers will feel that they have to log more hours than they're working, so that the very precious little spare time that they do have does not get allocated into some work. But we have to take a step back and wonder. And this has been a conversation in the industry for 3-4 decades, 5 decades, maybe longer now. There's a cultural shift that needs to take place, right? There has to be a better utilization of these hours. Oftentimes you have junior bankers responding to requests from their bosses, and they're not hearing back until they come back from their dinner with their client, notice something minor or major, but suddenly say, fine, I might be looking at this at 9:30 p.m., but now that I'm responding to you, I want the fix in the next 2 hours, the next 3 hours, the next 4 hours. That cultural change is more important than figuring out how to cap these hours. And I don't know how you solve for that easily.
But I'd say technology has changed the game, because part of the reason you're in the office is because you had no other resources. If you wanted to fix that thing in 3 hours, you had to be in the office. Now I can do it from my phone at the Yankee game. Sri Natarajan, senior finance reporter for Bloomberg News. Great article today on junior bankers on Wall Street. They're working pretty hard. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got red and green on the screen, a little bit of a mix, with the NASDAQ leading the gains, up about 0.2%, 48 points. We have the Dow down 0.1%, 65 points. The S&P 500 up 0.1%, or 6 points. The two-year yield at 3.67%. That's up 2 basis points. The yield on the 10-year at 3.69%, and that's up 3 basis points. The commodities, spot gold higher, $2,549 an ounce. We have Brent crude $71 a barrel, WTI crude $68 a barrel. When I go to currencies, we have the dollar weaker, Japanese yen weaker. We have the euro up 0.2%, British pound up 0.2%, Bitcoin up 1% at about 58,000. Moving the markets, Moderna down 16%. The company slashed its research budget as its vaccine sales disappointed. Then you have shares of Signet Jewelers. They're up 18%. The owner of Zales said engagement sales are up, so that's some good news there. And some deal-making news. General Mills agreed to sell its North American yogurt business for $2.1 billion to two French dairy companies. General Mills is down about 1%. Seven and I shares higher. They're up about 4% in Japan. Couche-Tard said they're going to be talking about sweetening the deal, possibly raising its offer price. We have Couche-Tard. They're up about 0.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa Mateo. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We cover all the top news in business and economics and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries worldwide, and today they're celebrating their 15-year anniversary. Big deal. Woohoo. Lots of partying. It's going to be, these guys are going to get crazy. One stock they're going to all be watching, though, even they're going to be at this party, is Boeing. The stock is up by 0.6%. We're just hours away from a countdown here. Members of Boeing's largest union are going to vote on the first comprehensive labor contract in 16 years today. It's looking at about 25% guaranteed wage increase. This is the largest offer in Boeing's history. Plus, the next plane, as long as it's done in the next 4 years, can be built in Puget Sound. Here's George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst. Does the union strike?
More and more, I think they will. Yeah, the noise I'm getting from, we're even hearing it here in New York and New Jersey. The noise I'm getting from the West Coast makes it sound like there's going to be a strike.
And is this because the deal actually isn't good enough, or is this just because the unions finally have a certain amount of power that they haven't had in a very long time?
Yeah, I mean, I think it goes to definitely some power that they've had that they haven't had for a while. But Boeing has been working, I think, to minimize the union over the last decades, right? And so 787 is probably a really good example where they set up 2 lines for 787. They put one in South Carolina near Charleston, one up in Everett, right? One was a non-union line. They've tried to organize it, but the Carolina line is a non-union line. And so they're building about half in each place. And now what Boeing has done is migrated all of that work down to the Carolinas, right? So if you're the machinist, you're like, look, that's just an example of where they've taken jobs away. And at the last, contract, they lost pensions and things like that, right? So the union hasn't had a lot of power. And, Boeing's been working to really minimize costs at the company, and the labor force has been one of the places they've been trying to do it, right? And so this is their opportunity to make up for those years of pain and lost jobs, and I think that's why they probably go out on a strike and look for more.
I mean, with all the manufacturing missteps that Boeing has had to deal with in the, over the last 3 or 4 years, quite frankly, they're not producing where they need to produce. Boy, if there's ever a time that the union has leverage, this is it. What do they really want?
Yeah, they need it, right? Boeing needs that workforce, that skilled workforce. That's part of the problem after the pandemic is we lost so much skilled workforce in aerospace. And if Boeing has any hope, I think, of building to the rates they want, they need these folks, right? So what do they want? I think they're going to want more than 25% pay increase, right? I think you've seen, even some aerospace companies like Spirit, we were up in the 30s, I think, around where they got the increase. But I think what really, really, really matters long-term for the union rank and file in Puget Sound and for the union, for the machinists, is the airplane, right? So the agreement now is they get to build the airplane if it's announced, or, I haven't seen the legal documentation, but essentially Boeing has got to launch this airplane in the next 4 years. And as I understand it, it's the next airplane that they've agreed, if they launch in the 4 years, to do it in Puget Sound. If I'm the union, I want the next narrow body, the 737 successor. I mean, at Bloomberg Intelligence, we think they need a new airplane, right? The problem with the 737, too low to the ground.